Good morning, and yes, welcome to this session of the direct taxation. And yes, guys, we have been successfully able to complete all the 5 heads of income. Many congratulations to all of you for achieving this big milestone. Guys, the 5 heads of income and residential status cumulatively holds at least 50% of marks in your examination. Yes, a few chapters holding big percentage of marks in your examination. These are the 5 most important chapters, the 5 heads and residential status. In the last section, we have been able to successfully complete the 5 heads of income along with residential status. And I am glad to state that many of you have also given me test of all these chapters. So they are not only prepared, but they are prepared to go for the kill. They are prepared to go for the big game in June 2022. Many congratulations to all of you, all the students who have religiously been following this test series and the marathon video series. Many congratulations to all of you. You have successfully been able to complete the 5 heads of income along with residential status. Yes, you might be feeling that, sir, our friends who are giving June 2022 attempt, sir, they are not attending marathon videos. They are not giving your test. We have not seen them in test. Guys, don't feel that you are missing out on something. Sir, we are not able to enjoy our time. We are not able to watch our favorite movies. We are not able to go out and venture into water parks or some jumping parks. We are not making merry. We are not doing what we always want to do. We are not able to do that, and all our friends are doing what they want to do. And here we are in the marathon, in the test series, regularly working hard for June 2022 attempt. Sir, we are missing out on our personal profits, on our personal pleasures. We are missing out on that. Guys, I can give it to you in writing. I can give it to you in writing. You are not missing out on anything. 5 years down the line, when those of your colleagues, those of your fellow mates will be struggling for job, you will be doing a job worth 10 lakh rupees, 14 lakh rupees in big companies like ITC, Vedanta, etc. And at that point in time, you will be making merry. You will be enjoying your water parks, theme parks, your favorite series, television series, your favorite sports. You will be enjoying all of those things. And those students who are currently making merry, they will be struggling hard for getting a decent job. So do not feel that, sir, we are investing our time in studying. They are not. Sir, why should we study? Don't even have an iota of doubt in that particular respect. Guys, please continue working hard. Wholeheartedly give me all the tests which I'm taking every Sunday. This Sunday, the test is of chapter income from other sources. The entire chapter will come in test. Wholeheartedly give the test, and trust me, 4 years down the line, 3 years down the line, you will be proud of yourself that yes, you attended these marathon lectures, you religiously gave the test. You'll be feeling proud on yourself. Yes, that feeling of pride will overshadow the hard work which you are doing right now. You will feel that, sir, we could have done even more hard work. The feeling of pride, the feeling of power, the feeling of having abundant money, the feeling of buying whatever to buy in the world, the feeling of our parents being proud on us, the feeling of our parents getting whatever they want, whatever they deserve, whatever they desire, the feeling of we gifting some expensive gifts to our parents which they always wanted but could not afford. All those feeling will be far better than this hard work, the pain which you are going through right now. So do not worry about the pain which you are going through right now. Do not worry about the late night midnight oil that you are burning right now. Just focus on the goal, which is June 2022 examination. And guys, let me tell you one very important thing. The pain is temporary. This pain which you are going through is temporary. But the pride which you are going to get after June 2022 attempt, the pride which you are going to get after June 2022 attempt will be permanent. The pain is temporary, but the pride will be permanent. So I'm very, very happy that yes, my students of CMA Intermediate and CMA Final are working really, really hard towards their goal of June 2022 examination. And yes, they're going to come out with flying colors. I'm eagerly waiting to hear from you. Sir, we got a rank, or we scored above 80 marks in direct taxation. We scored above 80 marks in financial accounting. We scored 19 costing. I'm eager to hear all these words from all of you. So guys, do not feel demotivated. Do not feel that you're missing out on something. Do not feel that you are working hard and your friends are not working so hard. Do not have any such grudges in your mind, in your brain, in your soul. Just work hard towards one goal, which is June 2022 examination. So yes, once again, many congratulations for completing the 5 heads of income. And just to reiterate, audit test series has started. Audit WhatsApp group has been created. Audit test is happening every week. So if you are giving group 2 of CMA Intermediate, please register yourself in the audit group. Please register yourself. If you are a final student, if you are a CMA final student, then 2 test series are going on: cost audit test series and BVM SPM test series. Both the test series are going on every Saturday. Test happen. There's a schedule which is there in the communities tab. Do follow that schedule, and please give test of CMA final as well. If you are a CMA final direct taxation student, group 3 student, then you should give all the chapters which I'm teaching for both intermediate and final, like the 5 heads of income, PGP, capital gain, are relevant for CMA final as well. And yes, I'll be taking up CMA final direct taxation test series separately, where the unique chapters like international taxation, which is not there in CMA Inter, penalties and prosecution, which is not there in CMA Inter, I will take tests for those chapter separately in the test series. That test series will be starting after the test series of CMA Intermediate will end. So yes, today we are going to start one of the very small chapters of your syllabus. Rather, these are twin brothers, twin sisters chapters. The chapter is clubbing. The second chapter is set off and carry forward. Okay, so these 2 chapters are small chapters, are not very lengthy chapters, but yes, a question of 4 to 5 marks can come from these chapters in your examination. So these chapters are in that respect quite important, but since they are very small, they are short, you will be able to revise them very, very quickly. So today's session is dedicated wholly and solely on the chapter clubbing of income. We are starting the chapter clubbing of income. And yes, before we start the chapter, please hit the like button on this video so that I am motivated to continue providing you ample marathon videos of whatever subject whatever topic you want in direct taxation. So just hit a like button. Yes, we are starting now the concept of clubbing of income. So I want to ask you, what do you mean by clubbing? What do you mean by clubbing? What is a club? Okay, so what do you mean by clubbing? Please answer in the chat box. टेस्ट में मार्क्स जिनके अच्छे नहीं आते वो भी क्या रॉक करने वाले हैं? हाँ भाई हाँ, जिनके मार्क्स अच्छे नहीं आते वो भी रॉक करने वाले हैं, क्योंकि टेस्ट देना अपने आप में एक बहुत बड़ा माइलस्टोन है. तो अगर आपके टेस्ट में मार्क्स अच्छे नहीं भी आते तो भी इट्स ओके. ओके, व्हाट डू यू मीन बाय क्लबिंग? Okay, what do you mean by clubbing? What is the meaning of word clubbing? Okay, Abhishek is saying adding. Pooja is saying putting together. Okay. Combining. Ashok is saying combining. Oh, no. Someone is saying to dance at night in the discotheque. No, I'm not talking about that clubbing. Nalayak. Someone is saying to dance in the discotheque. Not that clubbing. No. Nalayak. No, it is not clubbing, which is going to club, going to discotheque at night and dancing and having cold drink and having, some fun and frolic. Yes, right. Om Kakati is right. It means combining. It means to combine, to join, to put together. Yes, that is clubbing. Okay. So let me first of all define what do you mean by clubbing. Okay. Now, there is income of Mr. A. There is income of Mr. A. Mr. A is earning some income. Now, ideally, that income should be taxable in hands of Mr. A. Suppose Mr. A is earning income of rupees 1 lakh. So what do you think? Who should pay taxes on this 1 lakh? Mr. A is earning income of rupees 1 lakh. Who should pay taxes on this 1 lakh? The question is that. Who should pay taxes on this 1 lakh? Of course, Mr. A should pay taxes on this 1 lakh. On this 1 lakh rupees, Mr. A should pay the taxes. But under the clubbing provisions, what happens is income of Mr. A, but the taxability arises in hands of Mr. B. Yes, some other person. So income of Mr. A will be Nalayak Abhishek. Abhishek is saying go out to nightclubs. Abhishek, you don't have to go out to nightclubs right now. Now it is time to study. Nalayak. So clubbing means income of some other person getting clubbed in hands of some other person. So income of Mr. A getting clubbed in hands of Mr. B, and then Mr. B is paying taxes on that income. That is known as clubbing of income. In an ideal situation, in a very plain vanilla situation, guys, income of Mr. A should be taxable in hands of Mr. A only. If in Mr. A is earning income, then it should be taxable in hands of Mr. A. But sometimes what happens is income of Mr. A is clubbed in hands of Mr. B, and then Mr. B has to pay income on the has to pay tax on the income of Mr. A. So Mr. B will pay taxes on two incomes, his own income and income of Mr. A. He will pay taxes on two incomes. Okay, this is known as clubbing. But sir, this is so unfair. This is so grossly unfair. This is incorrect. This is absolutely exploitation. This is wrong. Why would Mr. B pay taxes for the income which is earned by Mr. A? Why would Mr. B pay taxes? This is wrong, sir. This is wrong. Guys, these provisions emanate from over smartness, from the the shrewdness of the taxpayers, over smartness of the taxpayers. How? I'll tell you. Mr. A is an employee of a very big company. His salary is 14 lakh rupees per annum is his salary. Mr. A is an employee of a company. His salary is 14 lakh rupees per annum. He has a minor child who's only 6 years old, right? Mr. A diverts his income to his minor child's account. So he requests the employer, dear employer, my salary is 14 lakh rupees, but out of 14 lakh rupees, you please transfer 5 lakh rupees to my kid's bank account and say that my kid is your employee. This is very, very irrational, because a 6-year-old kid cannot be an employee of a person. He cannot work, right? So in that case, guys, this is the shrewdness to avoid tax. How would tax be avoided? Guys, salary slab, 5 lakh rupees income for a resident is not taxable. So in a salary kind of a situation, Mr. A will get an exemption of 5 lakh rupees, and his son also get an exemption of 5 lakh rupees. Double benefit will be acquired. These are the situations where over smartness of the people result into tax evasion, and that is why clubbing provisions are in place. Now I'll change this scenario, guys. Okay, now suppose Mr. A is earning salary income from his company, and he is having a minor child, and this time it's not the company who's paying salary to the minor child, but it is a child's own talent. A child is a singer, or child is a born dancer. Some children dance at a very young age. He's a dancer, and he participates in some competition and wins some amount of money. Guys, that money cannot be clubbed. That money cannot be clubbed, because that money is earned by Mr. A's son himself due to his skill, due to his talent, due to his natural ability to dance. That is the reason why this income has been earned. So you have to see, okay, you have to see whether there is a malified intention in the transaction. If there is a malified intention in the transaction, if there's a wrong intention in the transaction, only then clubbing provisions will apply. Otherwise, clubbing provisions will not apply. So that is how we apply the clubbing provisions. So let's start. So yes, the clubbing provision will apply in certain cases. They will not apply in all cases. They will apply in certain cases, and those certain cases are defined in the Act itself. In those cases, clubbing provisions will apply, and clubbing provisions will have a harsh repercussion that income is earned by someone else, but it will be taxable in hands of someone else. So there will be hard repercussion in case of clubbing provisions. So before coming on to the clubbing provisions, let us read certain general principles, certain general things which are there with respect to clubbing. Okay, so computed income to be clubbed. First principle is that, guys, whatever income you want to club, first of all, you have to compute the taxable income from the total income, and then the clubbing provision will apply. So for example, Mr. A's income is taxable in hands of Mr. B, right? Mr. A's income is taxable in hands of Mr. B. Suppose now, while Mr. A's income is taxable in hands of Mr. B, guys, whatever is the computation of taxable income which is there in hands of Mr. A, that should be computed first, and then the computation should be added in hands of Mr. B. I'll give you a simple example, okay? Now, Mr. A is earning income from house property worth 10 lakh rupees. And the clubbing provisions are saying that this 10 lakh rupees should be clubbed with the income of Mr. B. Now, guys, before clubbing 10 lakh rupees in the income of Mr. B, you have to first compute the taxable income which will accrue from this 10 lakh rupees. You remember in house property sections we had done NAV, then 30% of NAV should be reduced, then will come the taxable income. You compute GAV computation is a different mechanism altogether. All those procedures which are required to be done, they are to be done first while computing the taxable income of Mr. A, and then the taxable income is to be clubbed in hands of Mr. B. So the first principle is computed income to be clubbed, not the gross income, not the income which is gross is to be clubbed, but the computed income is to be clubbed. Whatever income is computed out of the provisions of the Income Tax Act, that income will be the income which is clubbed. So the most important thing is that computed income should be clubbed and not the gross income. Okay. Second provision, clubbing is done headwise. Now this is a very, very important provision, guys. Suppose the income which is there in hands of Mr. A is from income from house property. So in hands of Mr. B also, the same income will represent income from house property. It should not be so that, Mr. B is offering this income as income from other sources. No. Whatever head was applicable to Mr. A, Mr. B should also offer this income to tax under the same head. So if Mr. B has house property income, then Mr. A's income should also be added to Mr. B's house property income, and then the taxability should be ascertained. So the house property income of Mr. A should be clubbed with the house property income of Mr. B. So head-wise clubbing should be done, head-wise, which means whatever head is the income taxable in for Mr. A, the same head the income will be taxable in hands of Mr. B. So clubbing should be done head-wise. Third, deduction under Section 80 is allowed to the assessee whose hands income is clubbed. Now, the question is, income is taxable in hands of Mr. B. Income is earned by Mr. A. Who should claim Section 80 deduction? Right? Because Section 80 deduction can also be there. Sir, what is Section 80 deduction? Guys, Section 80 deduction is when you out of your income deposit some amount or contribute some amount to some investments, you will get certain deduction from Section 80C to Section 80 capital U, right? All those deductions will be applicable in hands of Mr. B. Who should claim the deductions? Mr. B should claim the deductions under Section 80. From Section 80C to 80U, Mr. B should be claiming the deductions. Mr. A should not claim the deductions. Mr. B should claim the deductions because taxability is arising in hands of Mr. B. So Mr. B should claim the deductions. Then the fourth rule is clubbing of loss shall also happen. So guys, if clubbing provision is applicable on income, then clubbing provisions are applicable on losses as well. So if Mr. A has some loss from house property and that is ought to be clubbed with the income of Mr. B, then loss should also be clubbed. Okay, along with the income, the loss should also be clubbed. So it's not only that income should be clubbed, income and losses both should be clubbed. Yes, sir. If you club loss of Mr. A with profit of Mr. B, then profit of Mr. B will reduce, taxability will reduce. So what? I'm okay with it. Income Tax Act is okay with it. If incomes are clubbed, then losses will also be clubbed. So if Mr. A has some losses, that will also be clubbed under the relevant head of Mr. B as well. So losses will also be clubbed. So clubbing loss shall also happen. Clubbing of loss shall also happen. Next, TDS credit to be given to the person in whose hands the income is clubbed. Very, very important principle, guys. Now, while Mr. A received the income, there must have been some TDS deduction. So what is TDS deduction? TDS means tax deducted at source. So when income was being given to Mr. A, there would have been some TDS which would have been deducted from income of Mr. A, which Mr. A should be given the credit at the time of filing of return of income. This is the concept of TDS. Now, if TDS is being deducted for Mr. A, guys, the income is being offered by Mr. B. Now, problem is Mr. A, even if he claims TDS, what is the use? Because he's not offering the income to tax. This income is being offered to tax by Mr. B. Mr. A is not offering the income to tax. Who's offering the income to tax? Mr. B is offering the income to tax. Now, will the TDS claim of Mr. A be allowed to Mr. B? Answer is yes, because this claim is useless for Mr. A. What will Mr. A do of this TDS claim, because he's not offering that income to tax? What is the use of this TDS claim of Mr. A? So, guys, I'll give you a practical example. Okay, please don't get confused. I'm giving you an example. Mr. A has income of 1 lakh rupees, out of which he deducted TDS of 10,000 rupees, right? Mr. A got an income of 1 lakh rupees, but the payer of the income deducted 10,000 rupees, which means Mr. A received 90,000 rupees. Now, ideally, Mr. A will file a return of income with 1 lakh rupees and tell Government of India, hey, Government of India, listen. I have already paid taxes on this 1 lakh rupees. Please don't recover any taxes from me. This is the usual circumstance. Mr. A will request Government of India that, look, Government of India, I have already paid taxes in the form of TDS on this 1 lakh rupees income. Please don't take any more taxes from me. This is what Mr. A is going to tell to Government of India. Now, the situation is, when this income will be clubbed with income of Mr. B. Guys, Mr. B has not, got this deduction done. This deduction was done by Mr. A. Now, the question is whether Mr. B can tell Government of India, hey, Government of India, I have already paid 10,000 rupees of taxes on this income. Please don't recover taxes from me. The same thing what Mr. A was telling to Government of India. Can Mr. B also say the same thing to Government of India? That is the question. Answer is yes. Mr. B can say this thing to Government of India, because Mr. A will not pay any taxes, will not offer this income to tax. So even the tax credit will also not be taken by Mr. A. Therefore, Mr. B is eligible for TDS credit. Whatever TDS is deducted from this particular payment, the income of Mr. A, the eligibility will be of Mr. B. Mr. B will be eligible for claiming the TDS. Absolutely, guys. Now, one very important catch in this entire concept, guys, this credit claim applicability is not there in case of advance tax. So suppose if Mr. A pays some advance tax on the income which he has earned, and if Mr. A tells Mr. B, take credit of this advance tax credit is not possible. TDS credit is possible, advance tax credit is not possible. Then, sir, Mr. A has already deposited the advance tax. Is it a waste? Is it completely gone? Answer is no, it is not gone. Mr. A will claim for a refund of advance tax. But the credit will not be given to Mr. B, just like in case of TDS. Credit will only be given in case of TDS to Mr. B. The advance tax will be refunded to Mr. A. That is the provision. So TDS credit can be given to the person in whose income the clubbing is being done. Okay. TDS credit can be shifted, but advance tax credit cannot be shifted. That is the principle. So these are the general principles of this particular chapter, clubbing of income. Now we move on to the specific sections. Yes, sir. So the first specific section is transfer of income. Now this is a very, very smart move which is undertaken by some of the SSEs, and this smart move is with the purpose of avoiding tax. Okay. So Government of India has pulled this loophole, has plugged this loophole. You cannot be over smart. So what is the over smartness which you're talking about? Guys, the over smartness which I'm talking about is, I have an asset that is yielding income to me. By way of an agreement, I transfer the income to any of my relative, like my spouse, my mother, my brother, any of my relative, I transfer the income to them with an intention to evade taxes. because they will be claiming slab rate exemption till 5 lakh rupees. I will be claiming slab rate exemption till 5 lakh rupees. There'll be double benefit which will be taken by both of us. There'll be double reduction which will be taken by both of us. So when double deduction will be taken by both of us, this will be a tax evasion. This will be a tax evasion. Guys, in this situation, when the asset, I am the owner of the asset, so I should be, earning the income also. How can I transfer income to someone else? But guys, I've done that. If I have done that, then that income will be clubbed in hands of income of the person who's owning the assets, in this case, me. I'm the owner of the asset. The income will be clubbed in hands of owner of the person. I'm the owner of the person. So income will be clubbed in my hands. Okay. So whosoever owns the asset, he should pay taxes on the income which is derived from the asset. Whosoever owns the asset. That is the condition, precondition. Owner is the person who's offering the income to tax. Owner is the person. All right. So when you transfer only the income, when someone transfers only the income to someone else, there can be two possibilities. Without transferring the asset, you have not transferred the asset. Asset is still in your name, but you have transferred the income. How smart are you? Okay. How smart? You have transferred the income, but you have not transferred the asset. Then guys, income to be clubbed in the hands of the transferor. So the person who's transferring the income will be taxable in hands of the transferor. So without transferring the asset, if the income is transferred without transferring the asset, then income will be clubbed in the hands of the transferor. Whosoever is transferring the income will be clubbed in the hands of the transferor. That is the principle, the first principle. So if you want to transfer the income, please transfer the asset also. So if I'm owning an asset, why would I only transfer income to someone else? I will also transfer the ownership of the asset. This is if you're transferring only the income and not the ownership of the asset. So if the income is transferred from that asset without transferring the asset itself, then it will be clubbed in the hands of the transferor. Second aspect is with revocable transfer of the asset. Now, you are transferring, if you're transferring the asset also and income also, clubbing provision do not apply. Okay. But if you do not transfer the asset, but you transfer the income, then clubbing provision will apply. Now, some over smart people will do another thing. What is that another thing? They would transfer the asset with revocable transfer. They would say that, okay, I'm transferring the asset to my spouse with a condition that after 1 year, this asset will be back transferred to me. Or after 2 years, this asset will be transferred back to me. This is again wrong. This is again wrong. This is known as a revocable transfer, a transfer which will revoke after a few years. What do you mean by revocation? What do you mean by revocable transfer? Means when the asset gets retransferred to the original transferor, or when the original transferor has the power to reassume the ownership or the rights in the assets. This is clearly over smartness. Currently, you are saying I am transferring the assets to my spouse, but after 5 years, these assets will be transferred back to me. This is known as revocable transfer, and this is treated as good as not transferring the asset and transferring only the income. So even in case of revocable transfer, income to be clubbed in the hands of the transferor. Income will be clubbed in the hands of the transferor. So in two situations, guys, in two situations, the income will be clubbed in the hands of the transferor. Situation number one, when you are transferring it, transferring only the income and not transferring the asset. You're transferring only the income, not transferring the asset. I have a house property. I am getting rent from it, and I am asking my tenants, okay, going forward, you pay the rent to my mother or pay the rent to my spouse without transferring the asset. Asset is still in my name. House property is in my name, but the rental income is being transferred to my spouse. This is known as transfer of income without transferring the asset. Guys, in this particular case, you are going to club the income in the hands of the transferor. You are going to club the income in the hands of the transferor. The video is actually at a high resolution. There shouldn't be any problem. Okay. All right. Now, guys, there are certain exceptions to this rule. Whenever there is a revocable transfer, whenever there's a revocable transfer which is revocable, even then we will not club income in certain cases. So there are certain exceptions to this rule. Now let us see what are the exceptions to this rule. So the rule is revocable transfer is subject to clubbing. Revocable transfer which is subject to revocation, transfer which is subject to revocation is eligible for clubbing. So revocable transfer is eligible to clubbing. This is the general principle. There are certain exceptions to this rule. Some revocable transfers are not subject to clubbing. What are those? We are going to study that. Okay. Transfer by way of trust or otherwise, which is irrevocable during lifetime of the beneficiary or the transferee. This is a very, very important exception, guys. Now, I am transferring my asset to my spouse, and there's a clause to it that if, suppose, God forbid, if my spouse dies, if my spouse meets with an accident and her life is ended, then guys, the asset will come back to me. You may feel that this is a revocable transfer and subject to clubbing, but Income Tax Act says no, this is not a revocable transfer. This is an irrevocable transfer because it is not getting the revocation is not getting fulfilled till the lifetime of the beneficiary. So if the revocation doesn't happen till the lifetime of the beneficiary, during the lifetime of the beneficiary, and if the revocation happens after the lifetime of the beneficiary, then I will say that it is a irrevocable transfer. If the revocation happens after the lifetime of the beneficiary, then I will say that it is a irrevocable transfer. Similarly, guys, in case of trust, okay, in case of trust, this is a trust structure. This is a trust structure. There's a trustee. Legal owner of the trust is the trustee. Then there is an appointer, the person who has appointed this trust, governed by a trust deed. There is a assets of trust, and there are certain beneficiaries. Okay, these are the beneficiaries of the trust. Now, where does this structure typically is used? This structure is used where parents wants to secure future of their children. Parents are suffering with some ailment, and they want to secure future of their children, so they create a trust. Because children are minor, they create a trust and they contribute their assets to the trust, and the trust will take care of the children. Once the children attain the age of majority, all the assets of the trust will be transferred to the children. This is the arrangement of a trust. Okay. Now, if the assets are transferred to the beneficiary of the trust, and the clause says that if the beneficiary dies, then the asset will come back to the trust, then is it a revocable transfer or is it an irrevocable transfer? Guys, Income Tax says it is a irrevocable transfer because the transfer is happening till the lifetime of the beneficiary. Till the lifetime of the beneficiary, the transfer is happening. So this is an irrevocable transfer and not a revocable transfer. So this is the exception to the rule that revocable transfer is subject to clubbing. Certain revocable transfers are not subject to clubbing. Certain revocable transfers are not subject to clubbing. Even when the transfer is revocable, we will not club the income. If the transfer is revocable till the lifetime of the is irrevocable till the lifetime of the beneficiary, then we will not club the income. Second exception, transfer made before 1st April 1961. This is the date when Income Tax Act came into play, which is irrevocable for more than 6 years. So if a transfer is irrevocable for more than 6 years, we will assume that it is an irrevocable transfer, but the deed should happen before 1st April 1961. Guys, from your exam standpoint, this exception is the most important exception. Okay, till the lifetime of the beneficiary, if the transfer is irrevocable, then we will say that it is an irrevocable transfer, and clubbing provisions will not apply in this kind of a transfer. That is the bottom line. Okay, I hope you got this particular point right. Yes, sir. All right, let's move on to the next section, and the next section is remuneration to spouse. Now, this is a very, very tricky one, guys. You know, with remuneration to the spouse, the people can actually play certain tricks to reduce tax, to evade tax. With spouse salary, they can play certain tricks. They can do some wrong things for claiming some deductions with respect to spouse. So now we are going to consider that. So remuneration to the spouse. What are the provisions which are related to remuneration to the spouse? That is what we are going to deal in now. All right. So remuneration to the spouse, section 64(1)(2). In what circumstances will the remuneration of spouse be added to the other spouse? So Mr. A, Mrs. B, Mr. A, Mrs. A, two spouses are there, Mr. A, Mrs. A. Mrs. A is earning income, Mr. A is earning income. In what circumstances will the income of Mrs. A be added to the income of Mr. A? That is what we are going to study now. Remuneration to spouse. All right. Okay, sir. Now, guys, assume that there is a company. Assume that there is a company. Okay. And Mr. A is drawing salary from that company. Mr. A is also a shareholder of this company. And this company is also providing certain salary to Mrs. A. Salary is provided to Mrs. A also. And the best part is Mrs. A is unqualified. She is not qualified enough for this salary and for this job. Mrs. A is unqualified. Guys, in this situation, typically in this situation, we can presume that since Mr. A is holding some interest in company, Mr. A, to avoid tax, is forcefully giving some income to Mrs. A. This is how we interpret this particular provision. Mrs. A is unqualified. Mr. A, owing to his substantial interest in the company, since he's a shareholder, he's a substantial interest shareholder, since he's holding substantial interest in the company, he is deliberately forcing income towards Mrs. A. And that is when salary of Mrs. A should be clubbed with Mr. A. So on a very, very broad perspective, I've explained you this particular section. All right. So let's come on to the fine blueprint of this section. What are the wordings of this section? Remuneration to spouse, section 64, 1, 2. Remuneration to spouse. So remuneration where the assessee has substantial interest in the concern. So where Mr. A has substantial interest in the concern, where Mr. A has got substantial interest in the concern, then guys, income of spouse to be clubbed with the assessee. In case Mr. A has substantial interest in the concern, then income of Mrs. A should be clubbed with Mr. A. Income of Mrs. A should be clubbed with Mr. A. That is the consideration. Okay, sir. Where assessee has substantial interest in the concern. If assessee, Mr. A, has substantial interest in the concern, then income of Mr. A will be clubbed with income of Mr. B. Mrs. B. Mrs. B's income will be added to Mr. A's income. Now, sir, what do you mean by substantial interest? We'll be studying it in the next slide, guys. Okay. Now, where both assessee and spouse have substantial interest in the concern, there can be a situation where Mr. A and Mrs. A both are having shareholding in the company. So in this particular situation, Mrs. A also has a shareholding in the company. Okay, guys, many people have their spouses holding shares of their company. This is a very usual industry practice, a very usual industry practice. So now, where Mrs. A also has substantial interest in the company, where both of them are having substantial interest in the company, then what will happen? So in that case, where both of them have substantial interest in the concern, then both whosoever has income from any other source, where both of have income from any other source, so obviously there will be some other source of income also for both of them, like they might be earning some interest from fixed deposit, or they might be earning some dividends from shares which are held in some other company. So where they are having any other source of income, then income shall be clubbed in the hands of the person whose other income is higher. So in my example, Mr. A, Mrs. B, Mr. A, Mrs. A. Okay, Mr. is also having shareholding in company. Mrs. A is also having shareholding in the company. Now the question is whether salary of Mrs. A should be clubbed with Mr. A, or whether salary of Mr. A should be clubbed with Mrs. A. Whose income should be clubbed in whose hands? That is the question under consideration. What will I see? I will see income from other sources. Suppose income from other sources of Mr. A is 20,000 rupees. Income from other sources of Mrs. A is 10,000 rupees. Then guys, income of Mrs. A should be clubbed with salary of Mr. A. Whose other income is higher? Whose other income is higher? In that person's salary, the other person's salary should be clubbed. So where both of them have other income, where both of them have income from other sources, income clubbed in the hands of the person whose other income is higher. Whosoever's other income is higher, the income should be clubbed in hands of that particular person. Where both do not have income from any other source, where both the assessees do not have income from any other source, then no clubbing provision will apply. Both of them will be treated as equal. Both of them will be treated as equal. So in case where both have substantial interest in the concern, We have two situations. Number one, where both have income from any other source, then income will be clubbed in the hands of the person who has higher other income. And if both have don't have any other source income, then clubbing provision will not apply. That is how we are going to club the provisions. Now there's an exception to the rule. Exception. What is the exception to this rule of remuneration? Guys, let's see the exception now. Exception is remuneration generated through the technical or professional qualification of the spouse is not clubbed. So if I tell you, in my example, if I tell you Mrs. A is a CMA, cost and management accountant, and she is handling the entire cost accounts of the company. Mrs. A is a cost and management accountant and she is handling cost accounts of the company. Then guys, her income will not be clubbed even if both of them are holding substantial interest of the company or Mr. A is holding substantial interest in the company. Her income will not be clubbed because she is professionally qualified to do this job. She is professionally qualified to do this job. So her other income will not be clubbed. So this is an exception to this rule that remuneration of the spouse should be added. The remuneration should not be added in case the spouse is professionally qualified. And guys, you need not copy these entire charts. I will be providing PDF of these charts on the WhatsApp group. Please be part of the WhatsApp group. The WhatsApp group number is 9643929913. In this particular WhatsApp group, I will be providing you with all the PDFs of all these chapters, so you can revise these chapters in a very short span of time using these charts. Okay, so don't worry, I'll be sharing these charts with all of you. All right, next is, what do you mean by substantial interest, sir? Who's having a substantial interest? Like in my example, I told you Mr. A is having substantial interest in the company. So what will define substantial interest? What do you mean by substantial interest? Okay, so substantial interest means in case of a company, assessee or his relative hold at least 20% shares in the company at any time during the year. So if the assessee, who's the assessee in our case? Mr. A. Mr. A is the assessee in our case. Either the assessee or his relatives taken together are holding 20% or more shares in the company, then we will say that assessee, that is Mr. A, is having a substantial interest in the company. If Mr. A is having a substantial interest in the company, then any remuneration given to Mrs. A will be clubbed in hands of Mr. A. Will be clubbed in hands of Mr. A. Now, in any other case, in other concerns, which means apart from company, if we have a partnership firm or AOP, BOI, HUF, any other kind of company, then what will happen? Assessee or his relatives are entitled to at least 20% of profits in the concern. Then guys, obviously shareholding will not be there, but profit sharing will be there. So 20% profits if you are eligible to assessee, including his relatives, then the substantial interest provision will kick in. Now, what do you mean by relatives? Relatives means spouse, brother, sister, lineal ascendant and descendant. Spouse, brother, sister, lineal ascendant. Lineal ascendant means the mother and father. Lineal descendant means the children, right? So spouse, brother, sister, father, mother, and children, they are known as relatives. So assessee along with the relatives should hold 20% of stake in the company or the other concern. Then it will be said that this particular assessee is having a substantial interest, and then provision of clubbing will apply to such assessees. Okay, sir, got it? Now, guys, we are coming on to transfer of assets by the spouse. When asset is transferred by the spouse, when asset, earlier we were talking about the situation where asset is not transferred, only the income is transferred. Asset is not transferred, only the income is transferred. We are talking about that kind of a situation. Now we are talking about a situation where asset is transferred from the one spouse to another spouse. Asset is transferred from one spouse to another spouse. Now the catch is, the asset will be transferred at a very, very, very low consideration or zero consideration. That is a problem. Asset is transferred at a very, very low consideration or zero consideration. Let's see. Adequate consideration. If the asset is transferred at adequate consideration, so for example, house property was worth 2 crores and spouse was given it at 2 crores itself, no clubbing provision will apply. We have no problems in it. You transfer your house property to your spouse. The rental income will also be henceforth given to the spouse. We have no problem. No clubbing provision will apply if the adequate consideration has been taken from the spouse. We have no problem at all. We have a problem where inadequate consideration is received from the spouse. Then we have a problem. If we are transferring the house property to the spouse at 50% of the price or 10% of the price or 20% of the price, inadequate consideration. Why would you transfer some asset to a spouse for an inadequate consideration? There shall be a reason for it. If there's no reason, we'll club your income. So what will happen is clubbing of income from the asset in the hands of the transferor. Whatever income will be earned by this particular asset, whatever income will be earned from this particular asset, the income will be taxable in hands of transferor. I'll give you an example, guys. Let's take a small example. Mr. A transfers his property to Mrs. A. The value of the property was 2 crores, but it was transferred at 1 crore. Mrs. A starts receiving rent from this property. Since Mrs. A is the owner of this particular property now, Mrs. A starts receiving rent from this particular property. Now, Mrs. A is definitely a recipient of the rent of this particular property, but the rent should be clubbed in hands of Mr. A. Why? Why? Because Mr. A had transferred this asset to Mrs. A at a inadequate consideration. At a very, very less consideration, Mr. A has transferred this asset to Mrs. A. Therefore, the income which is earned by Mrs. A, it is clubbed in hands of Mr. A. Income which is earned by Mrs. A, it shall be clubbed in hands of Mr. A. That is the provision. So the concept is very simple. In case of inadequate consideration, clubbing of income from the asset in the hands of the transferor. Whosoever has transferred this particular asset, clubbing shall happen in his own name. The clubbing shall not happen in the name of the transferee. The income shall not be said that transferee's income is there. It is not transferee's income, it is transferor's income. Clubbing shall happen in hands of transferor. There are certain exceptions to this rule. What do you mean by exceptions? Exceptions means even when Mr. A transfers some property to Mrs. A at a lower consideration, even then clubbing will not happen. What are those situations? What are those situations? Let's see. Number one, agreement to live apart. This is a situation of a divorce. Guys, in case of a divorce, Mr. A may transfer certain property to Mrs. A at a very, very, very low consideration. There is a possibility to it. In that case, rent income which is accruing to Mrs. A shall not be clubbed in hands of Mr. A, because there has been a divorce between Mr. A and Mrs. A. There has been divorce. Divorce means agreement to live apart. So if the asset is transferred pursuant to a divorce, pursuant to an agreement to live apart, then clubbing provision will not apply. Second exception, cases covered under section 27. So what is this section 27? Guys, let me remind you. We had studied income from house property, and in income from house property we had studied a section deemed ownership. Deemed ownership, which means even when one of the owner is not the owner of the property, he will be deemed to be the owner of the property, and income from house property shall be taxed in the hands of the deemed owner, right? For example, holder of an impartable estate. Holder of an impartable estate. So there is an estate which is impartible. Partition cannot happen of that estate. And I still remember the example which I gave you when I was revising house property with you. The example is, there are 4 brothers who are owning 4 floors in a particular building which was owned by their father. Father had transferred the building in the name of the eldest son. Eldest son had given 4 floors to the 4 brothers. Guys, the terrace area is the common area. The ground area is the common area. Now, these areas are definitely not a partition label. I mean, I cannot partition these areas, right? Then these areas will be taxable in hands of the holder, whosoever is holding it. Suppose the eldest son is holding it. Eldest son will pay taxes on this particular asset. Although this asset belongs to all 4 of them, but whosoever holds the asset, he will be deemed to be the owner. So such conditions were there under section 27, right? So wherever 27 section applies, and deemed ownership is already applicable in those cases, specifically in case of house property only, building and land, okay? In case of house property where section 27 applies, we will not apply section 64. Because income is already clubbed or income is already taxed in the hands of the deemed owner. The rectification has already been done under section 27. Need no rectification now. We do not need any clubbing now. When the rectification has already been done by section 27, we are fine with it. We will not apply section 64. When once remedy has been provided under section 27, remedy under section 64 is not required. So in those cases where deemed ownership principle applies, in case of house property under section 27, which actually is income from house property, guys, in those cases the provision of clubbing will not apply even when inadequate consideration is given. Okay, sir, got it. So this is a very, very good exception, guys. 27 section, if 27 applies, then 64 will not apply. Obviously, we will not club one income twice when it has already been clubbed under section 27. Why would we again club in section 64? All right, this is a very nice picture and I love this picture. Especially I love this Punjabi lady who's smiling in this picture. That's why I love this picture, guys. This is a very good picture which is explaining income on income concept. Concept of income on income is explained by this particular picture. Okay, income on income. Okay, I'll explain you the provision. I know you will not be able to see whatever is written in this particular picture. No, you will be able to see partially. All right. So husband gifts money to wife. There is a Punjabi Sardar guy who's earning good money and he is transferring some money to his wife. No tax exemption for given. Gifting money does not reduce the taxable income. So when husband gifts money to wife, wife receives this money as a gift. Wife will pay no income tax if the money received comes from the husband. If the money received is from friend, full amount is receivable and taxable as income. So guys, wife will not pay any taxes on this particular gift which is received. Okay, this will not be taxed as gift tax. We had studied section 56 of income from other sources. If you receive any gift from relative, it is not taxable in hands of wife. Okay, currently we are not dealing with clubbing sections, we are dealing with gift section. We are just discussing gift sections. So this gift which is received by the wife from the husband will not be taxable in hands of the wife. Okay, now we come on to our point. Our point is not whether this will be taxed as gift or not. Our point is whatever income has been earned by the wife using this money of the husband, whether that shall be taxable in hands of wife or in hands of husband, that is the question which we want to know under the clubbing provisions. Let's see. Now what happens is wife invests the gifted money and earns some income. So what does wife do? I'll tell you what does wife do. So 1 lakh rupees has been received by the wife. Okay, wife invests that money. Wife invests that money and wife earns some income from that particular money. Okay, wife invests that money somewhere and wife earns some income from this money. So wife earns 10% from business, whatever business she has opened. So wife earns 10,000 rupees from this money which has been received by the husband. Wife earns 10,000 rupees. So income will be clubbed with husband's income. Because clubbing provision apply, husband will pay tax on this income. So guys, on this income, 10,000 rupees, who will pay the tax? Husband will pay the tax. Because this income will be subject to clubbing provisions, and according to the clubbing provisions, income which is accrued to your spouse whom you have gifted some asset without any consideration, that will be clubbed in hands of the main spouse who has gifted the money. So 1 lakh rupees was gifted by main husband, right? The husband, the main spouse, right? He has gifted the money to his wife. Now wife has earned 10,000 rupees. This 10,000 rupees will be taxable in hands of husband owing to clubbing provisions. Now next part. Income gained from income of gifted money. Now this is a very, very important point, guys. Wife reinvest this 10,000 rupees. Wife reinvest this 10,000 rupees in some mutual funds, and mutual funds yield a dividend of 2,000 rupees. Mutual fund yields a dividend of 2,000 rupees. Now first income was 10,000 rupees, which was from business which was run by the lady. right? This was clubbed in hands of the husband, right? Now lady from this money had invested this money in mutual fund. From mutual fund there is a dividend of 2000 rupees. Now the question is whether this 2000 rupees will be again clubbed in hands of husband, or this will be taxable in hands of the lady. Answer is this will be taxable in hands of the lady, because guys clubbing provision only will apply till this point. Till this point the clubbing provision will apply. Clubbing provision will not apply beyond this point. Beyond this point clubbing provision will not apply. Clubbing provision will only apply till this particular point. Beyond that clubbing provision will not apply. So income from income, this is income number 1, this is income number 2. So income from income is not clubbed. Let me repeat. Income from income is not clubbed. This is the concept of income on income. So what does it say? Wife will have to pay tax on this income. Clubbing of income does not apply. So the second income which is there, clubbing provision will not apply on the second income. Clubbing provision will only apply in the first income, on the first income. That is the provision which is stated over here. Okay, sir, got it? So yes, this was an interesting provision which has been now introduced in the act. And yes, the income on income is not taxable, but the main income is taxable. Now we come on to the last aspect of our chapter, guys. Last aspect of our chapter, income of a minor person. Clubbing of income of a minor person. Minor person means a person who has not attained the age of majority, which is 18 years, right? Let's see what is the provision for income of minor child. Let me expand this a little bit so that visibility is absolutely fine for all of you. Okay, I hope the visibility is fine. Okay, now income of minor child, in what situations will it not be clubbed, in what situations will it be clubbed? So no clubbing in the following cases. Income will not be clubbed. Number 1, income earned by minor on account of his manual work. If the minor is doing some manual work and on account of his manual work the income is being accrued, so clubbing provision will not apply if manual work, due to manual work the income has been earned, or due to skill talent of the minor. Minor is a born singer, minor is a born artist, minor is a born dancer, and his income accrues due to his own talent, then the income will not be clubbed in hands of the parents. Income will not be clubbed in hands of the parents. Next is income of disabled child, deceased specified under 80U. 80U is a deduction, guys, and there are certain severe disabilities. So there are certain diseases which are specified under section 80U. If the child suffers from the diseases which are specified in 80U, then his income will not be clubbed. Whether he is earning that income manually from himself, his own hard work or not, income will not be clubbed in these 3 cases. So 3 cases where income will not be clubbed. Now the cases where income will be clubbed. All other cases like investment income or interest income, the income will be clubbed in hands of the parents. Okay. Clubbing will be done in hands of the parents whose total income is greater. Now the question is, in whose parent, in which of the parent hands the income should be clubbed, mother or father? So answer is whosoever's total income is higher without including such income. Whosoever's total income is higher, in that particular person the income clubbing should be done. So if father's income is 10 lakh rupees, mother income is 12 lakh rupees, then in the hands of the mother the clubbing should be done of the income which is earned by the minor, right? Then one more provision is there, that in case marriage doesn't subsist, so in case both the parents are living apart, they are divorced, in case both the parents are living apart, then guys clubbing is done in hands of the parents who maintains the child. Then the principle of higher income will not apply. Then the principle of higher total income will not apply. Then the principle will apply that whosoever maintains the child, whosoever whichever the parent is responsible for maintaining the child, in his hands the income will be clubbed. Okay, so that is the rule. And the last is we have an exemption of 1500 per child. There's an exemption from clubbing. So whenever you club income of a child in hands of the parents, then 1500 can be deducted from it. Okay, 1500 income shall not be clubbed. Over and above 1500 shall be clubbed. So this exemption is available 1500 per child in case clubbing provisions are applicable. 1500 rupees you should not club. Apart from that, whatever is there you can club. So this exemption is there under section 1032. This exemption shall be applicable in case of income of clubbing of minor child. So yes guys, these were the provisions of income clubbing of minor child which are applicable in your particular case. And yes, by this we conclude our today's session, and I'm just checking if any section is remaining. No, none of the sections is remaining. So we are probably done with all the important sections of this particular chapter called the clubbing provisions, right? Set off and carry forward of losses. Set off and carry forward of losses. The name of the chapter is set off and carry forward of losses. So there are two things which are there in this particular chapter, which I'm going to discuss. Number one, set off of losses. Number two, carry forward of losses. So there are two things which we are going to discuss. Number one, set off of losses. Number two, carry forward of losses. These are the two things which we are going to deal with in this particular chapter. Set off of losses. Second, carry forward of losses. Now, what do you mean by set off of losses? So guys, a particular person may earn income from various heads during a particular year. Let me take you back to the first class, the basics class, which we had studied, and the starting of our syllabus, basic concepts class. Okay, we had discussed that there are 5 heads of income: salary, house property, PGBP, capital gain, and income from other sources. We have 5 heads of income. This is what is our initial understanding while we were discussing basic concepts chapter. Now, these 5 heads of income will yield some income and or some loss. In some of the head, there can be losses as well, where expenses are more than the income. If income are more than the expenses, then it will be profit. If expenses are more and income is less, then it will be losses. So there might be losses, there might be profits in each of these 5 heads of income. So guys, it's not necessary that a person is earning income from all the heads, but yes, permutation combination can happen. For example, a person can earn income from house property and income from other sources. Or there's another person who's earning income from PGBP and income from capital gain. There might be another person who's earning income from salary as well as earning income from capital gain. So there can be various permutation and combinations. It is not necessary that a person will earn income from all these sources. There can be situations as well where a person is earning income only from one particular source. That is also a possibility. So any kind of eventuality is covered under this particular computation. So ultimately, we are going to get to GTI, gross total income. Now, one very important benefit of losses is that it will reduce our GTI, and hence it will reduce our taxes. It will reduce our GTI, and hence it will reduce our taxes. And therefore, special emphasis is to be given on losses. So yes, losses can arise in any of these heads. Losses can arise in any of these heads. Of course, in salary chapter, there is no possibility that losses can arise. But apart from salary, all other heads of income can have losses. And guys, those losses are very, very beneficial to the assessee. Why? Because it can reduce the gross total income. So if you have losses in PGBP and you have income in capital gain, it will be a wonderful situation, guys. We will set it off. This is known as setting off. Setting off means adjustment, adjusting. Setting off means adjusting. We will adjust the profits of one head from the losses of another head, and thereby reducing our gross total income. And therefore, we say that losses are very, very good from a tax perspective. Losses will reduce our gross total income. And since losses will reduce our gross total income, it will be very, very, very beneficial to us, because we will be required to pay lesser amount of taxes if gross total income is reduced. And that is how the losses benefit us. Now, income tax authorities have made certain rules regarding the set off of losses. And in this particular chapter, we are going to study all those rules which are surrounding the set off of losses. What do you mean by set off? First of all, set off means adjustment. Adjustment means setting off. Set off means adjustment, adjusting losses from profit. That is known as set off. Now, let's first talk about set off. And in the second half of the lecture, we'll talk about carry forward. What do you mean by carry forward? We'll discuss in the second half of the lecture. First, let's discuss about what do you mean by set off. Guys, set off means adjusting of loss from one head to profit of another head. This adjustment is known as set off. Now, set off can happen at two levels. Set off can happen at two levels. Before coming on to those two levels, let me get you back to basic concepts chapter where I had discussed the difference between heads of income and sources of income. There are two things: heads of income and sources of income. Heads of income are these five: salary, house property, PGBP, capital gain, income from other sources. These are five heads of income. And within these heads, there can be various sources of income. For example, capital gain can arise from sale of two assets. Capital gain 1, capital gain 2. House property income can arise from two house properties, house property 1, house property 2. Business income can arise from two businesses, business 1, business 2, business 3, business 4, so on and so forth. So, within the head, if you have multiple sources of income, then they are known as sources of income. And this is known as heads of income. This is known as sources of income. So sources of income is a subset of heads of income. Heads of income is the main thing, and sources of income is a subset of heads of income. That is how I can best explain or define difference between heads of income and sources of income. So guys, assume that I have two businesses. I take coaching classes. That is my first business. I also provide consultancy to some MNCs, to some corporate firms regarding their direct taxation profiles. I have two businesses: coaching, number two, consultancy. Now suppose my coaching business is running into profits and my consultancy business is running into losses. Then the first set off that I would expect from Government of India is to set off this loss from this profit. First set off that I would expect from Government of India is that it would allow me to set off my business 2 loss from my business 1 income. I should be allowed this set off. So suppose I have income of 2 lakh rupees from my coaching business. I have income of 2 lakh rupees from my coaching business. Sir, why are you lying? We know that your income is much higher than 2 lakh rupees. Guys, it's just an example, okay? It's just an example. Don't get emotional about it. Suppose my coaching business is earning me a revenue of 2 lakh rupees, a profit of 2 lakh rupees, and my business losses 0.50 lakhs, which means 50,000 rupees is the business 2 loss. So guys, instead of paying taxes on 2 lakh rupees, I should first be allowed a set off, and I should ideally pay taxes on only 1.5 lakh rupees. That is the ideal expectation which I have from Government of India, from the Income Tax Authority. This is known as setting off of losses from profits. This is known as set off of losses. So guys, now let me extend my income to also house property. Suppose I also have a house property, okay? Suppose I have a house property and I have only one house property. I have a house property and I have only one house property, and that house property is yielding me a loss of 1 lakh rupees. That house property is yielding me a loss of 1 lakh rupees. So how can house property income be a loss? Please answer in the WhatsApp group. Please answer in the WhatsApp group. How can house property income be a loss? Under what circumstances can house property income be a loss? Please answer in the WhatsApp group. Abhishek is saying that please discuss MTP. Yes, sure guys, sure. Within the coming week, I will solve the entire MTP in front of you. So that will be done. Yes, that is there in my to-do list. Okay, please tell me, how would the income from house property be a loss? Under what circumstances can house property income yield to a loss? Perfect. Jyotish Raj is perfect. Interest on loan can be higher than the income, because interest on loan is provided to an unlimited extent if the property is let out. So if interest on loan is higher than the income, then it will lead to loss. So guys, in this case, I have a loss from house property, right? I have two businesses and one house property. From business 1, I'm earning an income. Business 2, there's a loss. House property, there's a loss. Now, what should I first do? Should I first adjust this income of 2 lakh rupees from the loss of house property? or should I first adjust this 2 lakh rupees, this profit of 2 lakh rupees from loss from business? What should I do first? I need to set off. I don't want to pay taxes on 2 lakh rupees because I'm running losses under 2 of other sources of income which I have. So I don't want to do that. Okay. I want to set off. I want to set off my income from losses. So guys, if you set off the income within the same head, let me use the terminology first. If you set off income within the same head, so head of income is PGBP and you have 2 sources of income. If you set off income within the same head, that is known as intra-head adjustment. That is known as intra-head adjustment. Intra means within. Intra means within. Guys, you must remember, you must be having in your school time intra-school competition and inter-school competition, right? Within the school, when competition happens, it is known as intra-school competition. My school had 4 houses: Sapru, Tagore, Tilak, Kabir. Okay, 4 houses were there, and 4 houses used to compete with each other. All the students were divided amongst these 4 houses. This is known as intra-school competition. But when our students from our school used to compete with other schools, that is known as inter-school competition. Similarly, guys, what is intra-head adjustment? Intra-head adjustment is when adjustment happens within the same head. When adjustment happens within the same head, it is known as intra-head adjustment. But when adjustment happens beyond the heads, okay, when adjustment happens within 2 heads, that is known as inter-head adjustment. So that is the difference between inter-head adjustment and intra-head adjustment. So there are 2 kinds of adjustments. There are 2 kinds of set-offs, which we will be dealing with in this particular session, guys. Inter-head adjustments and intra-head adjustments. Intra-head adjustments means adjustment which happens within the same head, and intra-head adjustment means it just happens beyond the same head. It happens within the different heads also. That is known as intra-head adjustment. So inter-head adjustment and intra-head adjustment. Intra-head adjustment happens within sources of income within the same head. That is intra-head adjustment. And inter-head adjustment happens within 2 different heads of income. Inter-head adjustment happens. That is the difference between inter-head adjustment and intra-head adjustment. That is the difference. Okay, sir, got it? All right, there are 2 generic notes which are written on the board, guys, and let's see what are those generic notes. So I think some of the part has been deleted on the board, so I'm just trying to bring that part back. Yes, the part is back. All right, so there are 2 notes which are there in this particular section, guys. Let's see what are those 2 notes. Notes are: number 1, first intra-head set-off shall be made, then inter-head adjustment shall be made. The first and foremost requirement of adjustment is that first you will make adjustment for intra-head. First you will make adjustment for intra-head. So this adjustment will happen first, and then if something remains, so business 1 should be adjusted with business 2 first, and then if something remains, then it should be adjusted against any other head. This is intra-head adjustment. So intra-head adjustment should happen first, and then inter-head adjustment should happen. That is rule number 1. Rule number 2, losses which cannot be carried forward shall be set off first. Now, guys, losses come with an expiry date. Just like your medicines, your medicines come with an expiry date. So suppose you have 2 tablets, okay, 2 strips of tablets, both of the same medicine. One of them is expiring after 1 month. Other one is expiring after 3 months. Which one will you consume first? Obviously, the one which is expiring earlier. So guys, over here, losses come with an expiry. What do you mean by that? Some of the losses can be adjusted only and only up to 8 years. Some of the losses can be adjusted only and only up to 4 years. Some of the losses can be adjusted for multiple years. Now, suppose you have an option of adjusting losses. You have 2 losses and you have to adjust one of them. One of the losses is expiring in 4 years. Second one is expiring in 8 years. Which one will you set off first? You have a choice of opting between two losses. One of the losses expiring in 4 years, second loss is expiring in 8 years. Which one will you choose first? Of course, guys, we will choose the 4 years ones. So the losses which are expiring first are to be set off first. Losses which cannot be carried forward, okay, losses which cannot not be carried forward should be set off first, and then the remainder losses should be set off. Then set off is mandatory even in the case of clubbing of income. So set off is a mandatory exercise. You cannot say that, sir, I don't want to set off my income from losses, I want to carry forward these losses, sir, I don't want to set off. No, you cannot say that. Set off is a mandatory exercise. Whether you want it or not, you have to mandatorily get the set off done. Even when you have clubbed income, even if you have income of someone else taxed in your name, which is clubbed income, even then your set off is mandatory. You cannot avoid set off. Set off is a mandatory exercise. You have to do set off. All right. So let's see what are the nitty-gritties of set off. Let's see what are the nitty-gritties of set off. So in this chapter, we are going to deal with two things: set off of losses, and next is carry forward of unabsorbed losses. Set off of losses and carry forward of unabsorbed losses. So let's start with set off of losses. Guys, as we have already discussed, set off is divided into two parts: intra-head set off, inter-head set off. What do you mean by intra-head set off? Intra-head set off means within same head, in two sources of income, we are going to set off our income and losses. Which means I have two house properties: house property 1, house property 2. House property 1 is yielding a loss, house property 2 is yielding a profit. I will first set off house property 1 loss with house property 2 profit. This is known as intra-head adjustment. When within the same head of income, you are adjusting profits and losses, these are known as intra-head adjustments. So intra-head adjustments are allowed, completely allowed. There's no restriction, there's no embargo on intra-head adjustments. However, there are certain exceptions whereby intra-head adjustment is not possible. So guys, barring these exceptions, intra-head set off is fully permissible. Barring these exceptions, intra-head set off is fully permissible. All right, so let's see the exceptions where intra-head set off is not permissible. So, cases where house property 1 income cannot be set off from house property 2 income, a loss. PGP 1 income is not permitted to be set off against PGPP 2 loss. There are certain situations. So these are the exceptions. Other than these exceptions, all intra-head adjustments are permissible. You can set off one source loss with other source income at any given point in time. That is absolutely allowed. It is not a problem at all, except for these cases. Now, what are these cases? Let's read one by one. Number 1, long-term capital loss. This is long-term capital loss. So what do you mean by long-term capital loss? So guys, if you are having some capital asset transfer, what do you mean by capital loss? Capital loss means where capital asset is being transferred from one person to another person. If you have a capital loss, which means your long-term capital asset has been transferred at a loss. So your sales consideration is less and your cost of acquisition is more. In that circumstance, you will result into a loss. It will be a capital loss. So guys, long-term capital loss cannot be adjusted against short-term capital gain. So intra-head adjustment is not possible in this particular case. Intra-head adjustment is not possible in this particular case. Long-term capital loss cannot be adjusted against short-term capital gain. So why is it so? Guys, because long-term capital loss is taxable at a beneficial tax rate, at a lower tax rate than the short-term capital gain. Barring a few cases like equity shares where STT is paid. I'm not talking about those exceptional cases, but as a general rule, long-term capital gain is taxable at a lower rate. Short-term capital gain is taxable at a higher rate. So if there is long-term capital loss, we will allow it to be adjusted against long-term capital gain only. We will not allow you to adjust long-term capital loss with short-term capital gain. Long-term capital loss can be adjusted only and only against long-term capital gain. Simple logic. Logic is very clear. Long-term capital gain taxable at a lower rate. Short-term capital gain taxable at a higher rate. So we will not allow you to adjust the income which is taxable at a lower rate. This is the income which is taxable at a lower rate. If it yields a loss, we will not allow you to adjust it with another source which is taxable at a higher rate. So long-term capital loss cannot be adjusted against short-term capital gain. Number two, loss from speculation business. Now, first of all, what do you mean by speculation business? Guys, speculation business means a business of probability, a business of chance. That is known as speculation business. I'll give you a simple example. I invest in shares of Reliance Industries Limited. I purchase the shares and keep it in my kitty for 7 years, 8 years, or 10 years, right? Because I am hoping that I'm going to gain some big benefit out of those shares. This is not a speculation business. This is not a speculation business. Now I'll come on to the speculation business. I purchase shares of Reliance Industries Limited worth 10 lakh rupees. I purchase those shares. I don't have the money. I don't have 10 lakh rupees. But as you are aware that the settlement is to be done, the payment is to be done at the end of the day. So during the day, when I purchase 10 lakh rupees worth of shares of Reliance Industries Limited, during the day, I even sell all of them. Thereby, I need not pay 10 lakh rupees to stock exchange. I need to pay only the differential between the purchase price and the selling price. This is known as speculation. In Hindi, it's known as satta. Satta, gambling. It is a speculation business where risk content is really high. It's a very, very risky business. And there's a very peculiar type of business, which is speculation business. So if you're into speculation business, speculation loss cannot be set off against any other business income. Within the same head, we are currently talking about the intra-head adjustment, right? So we are talking about the exceptions to intra-head adjustment. So within the same head, PGBP, you cannot adjust loss from speculation business with profit from any other business. You just cannot adjust it. You cannot set it off. Next, loss from section 35 AD business. Now, this is a very peculiar business, guys. You remember the 13 or 14 cases where we had some specified businesses for which capital expenditure was also allowed as a deduction. Such a huge benefit was given to those 13, 14 businesses. What were those 13, 14 businesses? Guys, beekeeping, slurry pipeline, hotel, etc., etc., etc. Cold storage, infrastructure business, etc., etc. So those 13, 14 businesses where huge benefit was given to the assessee, capital expenditure was allowed as a deduction in year one from profit and loss account. Huge benefit was given to the assessee under section 35 AD. Now, if huge benefit is given under that section, then any loss which is incurred under that particular business, that should not be allowed to be set off against income from any other normal business. So loss from section 35 AD business can be adjusted or can be set off only against income from 35 AD business and not from any other business. We're talking about intra-head adjustment, right? So I'll give you an example. Okay. ABC Limited has two businesses, 35 AD business and other business. 35 AD business has incurred a loss of 10 lakh rupees. Other business had incurred a profit of 5 lakh rupees. 35 AD business has a loss of 10 lakh rupees. We are talking about intra-head, right? Intra-head. This is also business. This is also business. Both are PGBP. We are talking about intra-head. We have not touched intra-head as of now. Okay. So loss of 35 AD. Income of other business. Question is, can it be set off? Answer is no. Cannot be set off. Because this is a highly beneficial provision. There are huge benefits which are accruing in this particular section to the assessee. So the profits are subject to special deductions. Therefore, losses shall not be allowed to be set off against any other business. Losses cannot be allowed to be set off against any other business in this particular case. So ABC Limited, 35 AD, there's a loss. Other business, there is a profit. Adjustment not possible. Adjustment not possible. But sir, if I have 235 AD businesses, so I'm also running a hotel, I am also into business of slurry pipeline. I have 235 AD businesses and the second 35 AD businesses is yielding a profit of 7 lakhs. Now the question is, can I set off this 10 lakh from 7 lakh as an intra-head adjustment? Answer is yes, this set off is possible. 10 lakh adjusted with 7 lakh, possible. 10 lakh adjusted with 5 lakhs, not possible. So that is the difference between a normal business and the business of 35 AD. So 35 AD business is not adjustable against any other business. Loss from 35 AD is not adjustable against income from any other business. Then loss from owning and maintaining race horses. Now guys, this is also a very peculiar nature of an activity. This economic activity is a very peculiar nature economic activity. Okay, fantastic. So Sayali Bhedi is also with us. Chulbuli Kudi, one of my favorite channels to watch, guys. Her vlogs are really cool. So Chulbuli Kudi is also seeing our live session as of now. And yes, welcome. Yes, the students are also excited. Kirti Batra knows about Chulbuli Kudi. So guys, one of the most hilarious and one of the most interesting channels which I usually watch, vlogs of Chulbuli Kudi. If you get time, do visit her channel. I am a fan of that channel, and I'm sure you will also be a fan of that channel because she brings up such new content. And the last video where she had forced her friends to eat toothpaste. Yes, she forced her friends to eat toothpaste, Colgate toothpaste. That was really hilarious. But yes, it was a little dangerous and worrisome also, because once you meet her, and what if she makes you eat toothpaste? That is a point of contention. You know, you need to be very careful in that respect. But yes, otherwise her channel is really amazing. Welcome Chulbuli Kudi in our session. All right, so we move on to our next head: loss from owning and maintaining race horses. Loss from owning and maintaining race horses. If you are owning and maintaining race horses, and if you are incurring loss from owning and maintaining race horses, then guys, this cannot be set off against any other head of income. This cannot be set off against any other source of income, because race horses is a very peculiar nature of business. It is a very peculiar nature. So this nature of business, this peculiar nature is to be, the loss should be set off from profit of this particular activity only. So owning and maintaining race horses, losses shall be set off against profit from owning and maintaining race horses itself. That is how this set off restriction is there. So we are talking about intra-head adjustment, and I'm saying that apart from these adjustments, all other intra-head adjustments are very much possible. Next exception is loss from a source exempt under section 10. Now this is a very, very important point, guys. There are certain incomes which are exempt from tax. There are certain incomes which are exempt from tax, and incomes which are exempt from tax under section 10, those incomes have no taxability. Obviously, taxability will not arise in those incomes. Now the question is, if taxability will not arise from those source of income, then if there is a loss from that particular source, should it be adjusted against income from other sources? Answer is no. When that particular source is not taxable, you're not paying taxes on the income, then why would losses be reducing your taxes? Your losses should be immune to taxes as well, because if income would have been earned from that particular source, then it would have been tax free. So losses should also be tax free. Losses should also be tax free. You know, losses should not reduce my taxes. If income is not increasing my taxes, losses should not reduce my taxes. A fair and justified principle. So in case you have a loss from any source which is exempt under section 10, for example, agriculture income, if you are earning agriculture income and you are earning income from that agriculture income, guys, that will be taxable. Agriculture income will be taxable. So agriculture income which is taxable, that agriculture income, if yields a loss, then that loss will not be adjusted, because agriculture income which is taxable is actually not taxable. Agriculture income is exempt from tax. So if agriculture activity is yielding a loss to you, that will not be allowed to be set off against any other source of income. So loss from a source exempt under section 10 is not allowed as an intra-head adjustment. The next one is loss from lotteries, crossword puzzles, race, card game, gambling, etc. So if you have income, if you have losses from any of these sources, guys, these define the casual income, right? Income from other sources, we had studied these income. These income are defined by the casual income. So these casual income are earned These casual income will be the losses from these casual income will not be allowed to be set off against income from any other source of income. The losses from these will not be allowed to be set off against any other source of income. Now the question is, gain is also not adjustable against any other loss. Now for them, for these two categories, if they yield a gain, then the gain is also not allowed to be set off against any other source of loss. Vice versa is also true. So the gain is also not allowed to be adjusted against any other source of loss. So for these particular two scenarios, these are very, very peculiar cases. The losses are also not allowed to be set off, and the gains are also not allowed to be set off against any other source. That is the principle. Okay, sir. So these are the exceptions to the intra-head adjustment. And now we move on to the inter-head adjustment, which is very, very important. Inter-head adjustment. How would one head of loss can be set off against other head of income? So that is known as inter-head adjustment. So inter-head adjustment we'll be discussing in the next slide, and then we'll be moving on to carry forward and set off of unabsorbed losses. Okay, guys, in this particular chart, this is a very, very important chart which I've created for you to understand and remember the entire concept of inter-head adjustment. This chart contains the entire concept of inter-head adjustment, and if you just remember this chart, your entire principles, concepts of inter-head adjustment will be absolutely crystal clear. Okay, so now we talk about inter-head adjustment, section 71. What do you mean by inter-head adjustment? Inter-head adjustment means when one head of income loss is setting off, is getting adjusted from other income of a different head. So for example, you have salary income and you want to adjust it against house property loss, or you have capital gain income and you would want to adjust it against PGBP loss. So now we are talking about inter-head adjustment, right? Inter-school competitions which used to happen, right? Always remember inter and intra. Intra-school means within the school. Inter-school means outside the school. That is the way to remember them. So inter-head adjustment. So guys, how is this chart prepared? Please understand. On this axis, I have plotted all the losses. On the x-axis, I have plotted all the losses. And on the y-axis, I have plotted all the gains. On the x-axis, I have plotted all the losses. On the y-axis, I have plotted all the gains. Now, one by one, we'll take loss of a particular head and see if that can be adjusted against any other head of income. So, for example, loss from salary cannot be adjusted against any other head of income because there is not a possibility that salary income will yield a loss. In case of salary, deductions can never be higher than the income. In case of salary, deductions can never be higher than the income. So in case of salary, loss cannot arise. So adjustment of that loss is not possible. It's not out. It's out of question. There's no question of setting off those loss. So in case of salary, loss is not there. Hence, not applicable. Not applicable. Not applicable. Adjustment with these gains is not applicable since salary cannot yield a loss. That is the first principle. Principle number 2, house property loss. Principle number 2, house property loss. There is a loss from house property. If there is a loss from house property, can that loss be adjusted against gains of any other head? That is the question under consideration. Loss from house property, can it be adjusted against gain from any other head? That is the question under consideration. Now I've divided this house property loss into two parts. House property loss more than 2 lakhs. House property loss less than 2 lakhs. So guys, if house property loss is less than 2 lakhs, then it can be adjusted against any other head of income. If the house property loss is less than 2 lakh, it can be adjusted against any other head. But if the house property loss is more than 2 lakh rupees, then it can be adjusted only against gain from house property and no other head. That is the principle. So house property loss can be adjusted against other heads only to the extent of 2 lakh rupees. That is the upper limit till which house property loss can be adjusted against gain of any other head. Let's move on to capital loss. What if we have a capital loss, which means we have sold an asset, a capital asset, and that has yielded a loss to us. Now that loss can be of two types: short-term loss and long-term capital loss. Short-term capital loss and long-term capital loss. Guys, the principle is very clear. Capital loss cannot be adjusted against any other head of income. Capital loss cannot be adjusted against any other head of income except for capital gains. Please understand the terminology. Please understand the shortcut marks which are given over here. Capital loss cannot be adjusted against any other head apart from capital gains. Guys, this is the capital gain, and capital loss can be adjusted only against capital gains. With one exception. Exception is that long-term capital loss cannot be adjusted against short-term capital gain. This we have discussed in our intra-head adjustment also. This is repetition of that point only, which we have just now discussed. Long-term capital loss cannot be adjusted against short-term capital gain. What is the reason? Reason is very clear. Long-term capital gain is taxable at a lower tax rate. Short-term capital gain is taxable at a higher tax rate. So we don't want to extend further benefit of adjusting long-term capital loss with short-term capital gain. We cannot adjust that. We cannot give you further benefit. This will be too much of a benefit to grant to. So long-term capital loss cannot be adjusted against short-term capital gain. Otherwise, within the capital gain scenario, within the capital gain head, everything else is possible. So capital loss cannot, cannot be adjusted against any other head, which means inter-head adjustment is not possible for capital loss. Inter-head adjustment is not possible for capital loss. That is the principle. Next one is PGBP. PGBP, again, PGBP can be split into two parts. Specified. What is specified business? The business which is specified under section 35 AD, which is having a huge benefit of deductions. Deductions are allowed from that particular in that particular section. If you are into those specified businesses, businesses are like cold storage chain, slurry pipeline. You are into beehiving. You are into infrastructure. You are into hotels, right? 3-star hotels. Then you are categorized as specified businesses, which are given in section 35 AD. So if you have a loss from specified business, it can be adjusted only with the income of specified business and from no other head. No other head. Loss from specified business can be adjusted only against the specified business and from no other head. And loss from any other business can be adjusted against any other head except for salary. With salary, you cannot adjust business loss. With salary, you cannot adjust business loss. With salary income, you cannot adjust business loss. But yes, salary income, house property can be adjusted. Other sources can be adjusted from salary income. From salary income, house property can be adjusted. Other sources can be adjusted. Business loss cannot be adjusted against salary income. Last but not all the least, income from loss from other sources. So how can there be loss from other sources? Guys, in some of the other sources income, there's allowment of deduction. Deductions are allowed. So sometimes deductions can be higher than the income. And at that point in time, there can be a loss from income from other sources. There can be a loss. So income from other sources, when it yields a loss, then can it be adjusted against any other head? Yes, it can be adjusted against any other head. It can be adjusted against any other head. So income from other sources can be adjusted against loss from other sources can be adjusted against income from any other source. So this is freely permissible. Some exceptions are also there over here. Some exceptions are also there, like in case of casual income, in case of some other specified other sources, there are certain exceptions which, although I have not written over here, please go to your study mat and do those exceptions quite well, because they are important. So yes, as a general principle, loss from other sources can be adjusted against any of the heads. It is freely permissible. The adjustment is freely permissible. Okay, sir, got it. So guys, this was inter-head adjustment. We have covered two aspects: intra-head adjustment and inter-head adjustment. This is set off of losses from income. How can losses be set off from income? That is yes, Arjun, I will share the answers of income from other sources test in the WhatsApp group. Guys, I know I have to share 3 things with you in the WhatsApp group. Number 1, test of income from other sources. Number 2, clubbing PDF. Number 3, set off PDF. So these 3 things will be shared to you in the WhatsApp group by today or tomorrow. That's my promise. Okay, now we move on to a very, very peculiar, a very, very interesting concept, which is carry forward of losses. Yes, let's move on to the next topic. Carry forward of losses. But sir, what is written beyond it? And why is it written? It says carry forward and set off of losses. Sir, we have just now completed set off, okay? We have just now completed set off. Then why are we studying set off again? This is not fair. We have already studied set off. Why are we studying set off again? This topic should have been only carry forward of losses and not set off. Why are we studying set off again? That is the question. Why are we studying set off again? Guys, relax, relax. Take a deep breath. Take a deep breath. Cool your temper. Don't be angry. I know you are too frustrated because of your examination, because of the vast syllabus. You are too annoyed. You're too frustrated. And if you are in the northern part of the country, then it's too humid and too warm also. It's too, taxing on your body also. I know that, but relax. There is a big, big, big difference between the set off which we had studied earlier and the set off which we are going to study now. There is a big, big, big difference between these two set offs. These are two absolutely different set offs, and they have absolutely different terms of taxability. I'll tell you how. Okay. First, let me tell you something about carry forward. What do you mean by carry forward? Let's discuss about carry forward. Carry forward means to bring in the subsequent period. That is in the meaning of carry forward, to bring to the subsequent period. That is the meaning of carry forward. I'll give you an example. Suppose I had business loss of 10 lakh rupees. I had business loss of 10 lakh rupees. I had capital gain of 7 lakh rupees. I had business loss of 10 lakh rupees. I had capital gain of 7 lakh rupees in the current year. After setting it off, I obviously want to set it off. Please see if it is permissible. Please see if it is permissible. Yes, please see in this table if it is permissible. Loss of non-specified business. Can it be set off against capital gain? Yes, it can be set off against capital gain, both short-term and long-term. So I am adjusting this business loss, my business loss, from capital gain. I'm adjusting it. It is permissible. Okay. After I set off my business loss from capital gain, I am remaining with 3 lakh rupees of loss. I have this 3 lakh rupees of loss. Of course, in the current year, I need not pay any taxes because I'm carrying a loss. The net loss is there in my GTI. Gross total income is a negative figure. Therefore, there's a loss. In the current year, I'm not going to pay any taxes on this 3 lakh rupees. Now, sir, this is a loss. Now, I have no other income in the current year. Is it waste? Or can I be allowed to carry it forward in the subsequent year? Answer is yes, you can carry forward it to the subsequent year. Now, talking about year 2, this is year 2, this was year 1. Talking about year 2, I have business profit of 5 lakh rupees and I have no capital gain. I only have business profit of 5 lakh rupees. Should I pay taxes on 5 lakh rupees or should I first adjust this 3 lakh rupees from 5 lakh rupees to yield a net income of 2 lakh rupees and then I pay taxes on this 2 lakh rupees? The rule says, please carry forward your unabsorbed losses. Please carry forward your balance losses to the subsequent year and you can set off your losses in the subsequent period incomes as well. So, this arrow which I have made, this arrow is carry forward of losses. This arrow is termed as carry forward of losses. When you carry forward your existing year's losses to the subsequent year, that is known as carry forward of losses. So this carry forward from current year to the next year is known as carry forward of losses. So this carry forward is actually the subject matter of our consideration today. This carry forward word means to take the unabsorbed losses to the next year and getting it set off in the next year. So, sir, now please tell us why are we being so candid about set off? Why are we reading set off again, guys? This set off means subsequent year set off. This set off means subsequent year set off. So please note, there are two kinds of set off which are there over here. Number one, set off which happens within the same year. This is the set off which we have already studied. And second one is set off which happens in the subsequent year, which is carry forward and set off. So there are two set offs which we are going to study in this particular chapter. First is the initial set off. Initial set off means the set off which happens in year one. That is the initial set off. And second is the subsequent set off, which means after carrying forward the loss from the current year to the next year, after carrying forward the loss from the current year to the next year, when we set off in the next year, that is known as subsequent set off. And yes, the rules of both of them are little different. Sir, we are so much puzzled. We are so much in agony. We are so much in pain. How many set offs are we going to study? Set off means set off. And are we going to study 2 rules of set off? Yes, you need to study 2 rules of set off. That is the requirement. So, guys, I hope this makes a lot of sense to you. Carry forward and set off of losses. This set off means set off after getting carry forward of losses. That is known as set off. This set off means after carry forward, when we adjust the loss, that is known as carry forward and set off of losses. So this set off is subsequent set off. Subsequent set off means after carrying it forward to the next year, when we set off our losses from the next year's profit. Please note, when we set off our losses from the next year's profit, that is this set off. When we set off our losses from the current year's profit, that is the set off which we have studied in our earlier slides. That is the difference. So now let's start carry forward and set off of losses. So first of all, we are going to study within the same head whether carry forward and set off of losses is permissible within the same head. Yes, guys, within the same head, carry forward and set off of losses is permissible. We can carry forward house property loss of the current year to the next year, and next year's house property income will be set off against next year's house property loss, current year's house property loss. It can be set off. Okay, so house property loss can be carried forward for a period of 8 years, and subsequently it can be adjusted only with the house property income. Guys, please tell me one very important thing. Okay, please tell me one very important thing. Please see this table. I'm coming onto this table back. Please see this table. Your 100% focus and attention is required, because now I'm going to deal with a very, very critical section. Okay, your 100% focus is expected and required. Please ask your mom to lower the radio or the grinder mixture which she is cooking food, to lower every noise in your house, because now I'm going to put forth a very, very important point. House property loss of current year could have been set off from income of current year of any other head. House property loss of current year could have been set off against income from any other head of the current year. But house property loss of past year, house property loss of past year which is carried forward in the current year, can only be adjusted against income from house property. That's it. No other income can be adjusted against house property loss which is carried forward. So if you adjust house property loss of the current year, then you have plethora of incomes to choose from: PGBP, income from other sources, capital gains, etc., etc. If you have house property loss of the current year, you can set off against plethora of incomes. But if you have house property loss which is carried forward from the previous year, then you have only one head of income from which you can set it off, which is house property itself. You cannot set off the carried forward house property loss from current year's business income. No, you cannot do that. 8 years is allowed to you for carrying forward this loss, and belated return, if even if you have filed a belated return, then also this loss is you'll be able to carry forward this loss in the subsequent period. Second, business loss other than speculation business. Business loss other than speculation business. If you have a business loss which is other than the speculation business loss, we are going to deal with speculation loss separately. If you have a business loss and you want to carry it forward, so when you carry it forward, it can be adjusted only against business loss. Okay, it can be carried forward till 8 years, and belated return is also okay. If you file a belated return, which means you file a delayed return, then also the loss is allowed to be carried forward. Guys, in some cases, I will not allow you to carry forward your loss if you are filing a belated return. I will not allow it. I will allow it only in a specific circumstances. So business loss other than speculation loss, this can be carried forward till 8 years. And even if you have filed a belated return, then also this loss can be carried forward. Okay, it's perfectly fine. Now, I'll again show you the contrast. Please see. Business loss of the current year can be set off against any other head of income. Business loss of the current year can be set off against any other head of income. But business loss of the previous year cannot be set off against any other head of income. It can be set off only against business income. That is the difference. This is the original set off, and the set off which we are currently dealing with is subsequent set off. That is the difference. Yes, sir, got it. Next is speculation loss or owning and maintaining race horses. So if you are into business of speculation, I've already discussed the definition of speculation in the earlier part of this lecture. If you are into speculation business or you are into owning and maintaining race horses, then guys, if you are earning loss from that particular source, then that can be carried forward only till 4 years. It can be adjusted only against income of speculation loss and owning and maintaining race horses. Till 4 years, it can be carried forward. And if you file belated return of the year of loss, in the year in which you have incurred loss, if you file a belated return, then we will not allow you to carry forward this loss. This loss gets wasted. You will not be provided any benefit of this particular loss. You have to file return in a timely manner. If you want to gain benefit of this loss. Okay, if you want to carry forward this loss, you have to file return in a timely manner. Next one is business loss from 35 AD business. If you are running a 35 AD business, and I have already discussed the 35 AD business, though 13-14 businesses which have been specified under section 35 AD. If you are running business losses from that 35 AD business, then guys, you will be able to carry forward and adjust it only with income of 35 AD business. The beauty and the best part of this particular loss is you will be able to carry it forward unlimited period of time. So guys, the expiry date of these losses are 8 years, 4 years. Over here, the expiry date is unlimited years. You can carry forward this loss to unlimited years. In subsequent period, whenever you will have any gain from section 35 AD, you can set off this loss from that particular gain, right? But the moot point of consideration is all these losses can be set off only against these incomes only, not under any other head. From these heads only, from these sources of income only, the losses can be set off if they are carried forward and set off, not the original set off. Original set off rules are different. Carry forward and set off rules are different. Both are different rules. Okay, sir. Then capital loss. If you are having any capital loss from sale of capital asset, then that is carry forward. You can carry forward till 8 years. Belated return is not okay. If you file a belated return, then you will not be allowed to carry forward your capital loss. Your capital loss will go for a waste if you file a belated return in the year when you have incurred losses. So in the year when you have incurred losses, you have to file return very much on time. On time, the return is required to be filed. Okay, sir, got it. All right, one very important thing over here also, guys, even when you are having a carry forward capital loss, then long-term capital loss can be set off only against long-term capital gain. Long-term capital loss cannot be set off against short-term capital gain. That rule still applies even when you carry forward and set off long-term capital loss. Okay, so that rule still applies, still holds good. Now, sir, are there any situation where I'm able to adjust my loss with any other head apart from the head in which the loss is incurred? Yes, guys, there's one situation outside same head. Okay. So in this particular case, you will be able to set off your brought forward loss from any other head, okay, outside the same head. This was within the same head, this was within the same head. So the example is, if you have unabsorbed depreciation, this is the most beneficial loss which any businessman can own. The most beneficial loss which any businessman can own. Unabsorbed depreciation can never go for a waste, okay? Unabsorbed depreciation is carried forward, you can carry it forward for unlimited years. Unabsorbed depreciation you can adjust from any other source of income, any other head of income. It is freely adjustable against any other head of income. Unabsorbed depreciation is adjustable against any other head of income. Beauty of this section, beauty of this provision. It can be carried forward for unlimited years. It doesn't get expired any which ways, except for salary and winning from lotteries and crossword puzzles. So the adjustment cannot happen from salary and winning from lotteries. These are the two exceptions which are there. Apart from these two exceptions, the unabsorbed depreciation can be set off against any other head of income, freely adjustable against any other head of income. That is the best part about unabsorbed depreciation. It's a very critical loss. It is a very critical carry forwarded loss, which is very useful for any businessman or for any person, because it is adjustable against any other source of income, first of all. Number two, it can be carried forward for unlimited years. Yes, the set off cannot happen against salary and winning from lotteries or crossword puzzles. These are the two restrictions. Apart from these two restrictions, there's no other restriction in unabsorbed depreciation. That is the best part about unabsorbed depreciation. And yes, unabsorbed depreciation is by far one of the most important brought forward losses, carried forward losses, which are there in your syllabus. So yes, what are we going to study today? Guys, we are going to study one of the most important topics of your syllabus, advance tax. Yes, advanced tax is the syllabus that is the topic which we are going to cover today. And yes, from an exam perspective also, guys, in your last examination itself, that is December 2021, question from this particular aspect was asked in the examination. It was around 4 to 5 marks. Yes, a small chapter, a very brief concept, but an important one, considering that it has been asked in the last examination. It can recur, it can reappear. So we need to be very much prepared for this particular topic, which is advanced tax. All right, so guys, advanced tax means what? Okay, first let's understand what do you mean by advanced tax and what is the requirement of drafting a section named as advanced tax. All right, so guys, we are talking about this financial year 2022-23. We are talking about financial year 2022-23, when a person is earning his income. So from 1st April 2022 to 31st March 2023, a person is earning his income. Now, naturally, guys, unless and until person knows what is his income, what is his taxable income, how can he pay taxes? So Government of India has to wait till 31st March 2023, till the time all the incomes are earned for this particular year. And then after 31st March 2023, whenever government wants, it can calculate the total income which has been earned by an assessee during the year and can recover taxes from that particular income. A fair point, a very fair point. And guys, that is the reason why this year is known as the previous year and the next year is known as the assessment year. This we had studied in our first chapter, basic concepts. This is the reason why this year is known as the previous year and the next year is known as the assessment year. That is the difference. That is the reason why the assessment year and previous year have a different annotation to it. Now, obviously, guys, during the next year, the income which has been earned for the previous year is required to be ascertained, is required to be assessed, and is required to be taxed, right? So in the assessment year, what are we going to do? We are going to assess the income which has been earned by the assessee in the immediately preceding year. And in that year itself, we should pay tax to Government of India. A very fair point, a very logical point, that yes, you please earn income till 31st March 2023. You earn income till 31st March 2023, and then you pay your income tax in the subsequent year. A very fair point. Corroborating this point, guys, return of income is required to be filed in the assessment year also. So for individuals, the timeline is 31st July of the assessment year. So 31st July 2023 is the year when return of income is required to be filed. What is return of income? Return of income means a summary of what all incomes have been earned during the year and what taxes has been paid by the individual. That is known as the return of income. So return of income is also required to be paid in the assessment year. All the computations are required to be made in the assessment year because it is practically not possible to make any exact computation in the previous year while you are earning income. It is not possible to compute a tax in the previous year itself. Now, there is a catch to this entire story. What is the catch? Government of India is asking you to pay taxes for this particular year in the same year. And this is known as advance tax. What do you mean by advance? Advance means a tax which is levied before time. The right time to collect taxes is, of course, after the end of the financial year. The right time to collect taxes is that. This is the right time to collect tax. Before you file your return of income, you should, pay your taxes to Government of India. This is the right time to pay the tax. But Government of India is saying no. You will pay the tax beforehand. That is, you will pay the tax in advance. This is known as advance tax. Now, sir, the question is, how can we pay the tax in previous year 22-23? We are earning income in the previous year 22-23. So unless until this year ends, unless until this year finishes, how will we know what is our income? How will we know what is our tax? We will not be able to know it. If we are not able to know it, how will we pay taxes in this particular year? We will not be able to pay taxes in this particular year. So what is the mechanism, sir, whereby we can actually calculate our advance tax? That is the main subject of this chapter, advance tax. The concept is very clear. Pay as you earn. Simultaneously, as you are earning your income, you have to pay taxes to Government of India in a simultaneous manner. That is the whole objective of this chapter, advance tax. Now, of course, guys, the question is, sir, how can we estimate income and expenses and taxes during this year? How can we pay advance taxes during this year? So, guys, the fundamental is very, very clear, is very, very simple. Government of India wants you to estimate your best estimate, your best judgment of what will be your taxes till 31st March 2023. Government of India wants you to estimate, to predict, to on a very broad level, to assess what will be your income and income tax during the year. That is the background behind advance tax. So what will be your income? You need to predict. So there are certain milestones which has been fixed by Government of India. First milestone is 15th June of the previous year. Second milestone is 15th September of the previous year. Third milestone is 15th December of the previous year. Fourth milestone is 15th March of the previous year. So as on these 4 milestones, you have to estimate your income which you have earned, and accordingly you have to pay advance tax. On the first milestone, which is 15 June 2022, you have to pay 15% of your total tax liability, which you have estimated. Again, guys, based on estimate, we are playing this game. This game is entirely based on estimates. What is your estimate of your income for the entire year? And guys, it's not difficult to estimate this income. Why? Because big companies have got their budgets. Big companies have got their plans which are in place, and those plans will reveal what is the income which may be earned in this particular year. So it's not a very difficult task. It's not a very Herculean task to estimate. Estimation is not very difficult. So on an estimate basis, Government of India is asking you to pay taxes. 15% of the total tax should be paid by 15 June 2022. Then 15 September 2022, 45% of the total tax should be paid up till 15 September 2022. Then 15 December 2022, 75% of the total tax should be paid up till 15 December 2022. And up till 15th March 2023, 100% of the total taxes should be paid by an assessee. So, in effect, before the year closes, advance tax is required to be paid up to the extent of 100%. This is known as advance tax. Yes, might sound a bit, a bit greedy from point of view of income tax department. Guys, doesn't matter if income tax is collected over here or income tax is collected over here. How would it matter? But why to complicate? Why to have this complication of advanced tax? Absolutely true, guys. There's no point of having this complication when the taxes could have been recovered easily after the end of the financial year. So this complication was not required, but Government of India wants to prepone the tax collections. It wants to prepone the tax collections. So TDS and advanced tax both are ways to prepone the tax collection. That the objective is that we want to prepone the tax collection, and with that objective, the provisions of advanced tax and TDS are introduced in our act. Okay, sir, we got the background. Now let's see some fine points regarding advanced tax. Advanced tax liability, if it is less than 10,000, or it is pertaining to a senior citizen who is not having PGBP income. If advanced tax liability is less than 10,000 for the entire year, okay, or it is paid by any senior citizen not having PGBP income, then no advanced tax is required to be paid. So there are two exceptions to this rule that advanced tax is required to be paid. The two exceptions are: number one, if the advanced tax liability for the whole year is less than 10,000, then advanced tax is not required to be paid. Or if advanced tax is paid by senior citizen, if the advanced tax is required to be paid by senior citizen who is not having PGBP income, then again advanced tax is not required to be paid. So under these two circumstances, advanced tax is not required to be paid. Then if you are falling under section 44AD, 44ADA business, guys, this we had done in our PGBP chapter, where I had told you that, if you are employed with certain specific professions or certain specific businesses, then you compute your income on an estimate basis. Presumptive taxation regime. So if you are into falling under category of presumptive taxation regime, then 100% of the advance tax is to be paid once and for all, which is 15th of March of the previous year. So advance tax in that case is paid on 15th of March once and for all. 15 June, 15 September, 15 December is not relevant for a person who is getting covered under 44AD and 44ADA presumptive taxation regime. Next are the milestones, guys. These are the 3 milestones which are there. According to these 4 milestones, you need to pay your advance tax liability. So suppose your total advance tax liability for the entire year is 1 lakh rupees. Okay, you have estimated it at 1 lakh rupees. When did you estimate? You estimated it on 15 June 2022. Okay, you have estimated the advance tax liability as 1 lakh rupees. So you have to pay 15,000 rupees up till June 2022. Then again, guys, on 15 September 2022, you have to pay total amount of 45,000. 15,000 you have already paid, right? 30,000 additional you have to pay. So this is up to 45,000, okay, or 45%. 15,000 you have already paid on 15 June. So on 15 September, what will you pay? 30,000 more you will pay, right? Similarly, on 15 December 2022, if your advance tax liability remains the same, 1 lakh rupees, then you have to pay 75% in total. 45% you have already paid. 30% you have to additionally pay, which means 30,000 rupees you have to pay on 15 December 2022. So these are cumulative amounts. Please note that these are cumulative amounts of payment which are required to be made, and that is how the advance tax liability is recovered by any assessee. Okay, sir, got it. So guys, this was the concept of advance tax liability. Now, one very important point: advance tax liability, if not paid on time, it invites interest under section 234B or C. Okay, so interest is invited under section 234B or 234C. Calculation of interest of 234B or C is applicable for CMA final students. It is not applicable for CMA intermediate students. CMA intermediate students should just remember these two interest sections, which is section 234B, section 234C, according to which interest is required to be paid if advance tax installments are not paid on time or they are not paid sufficiently. Then interest is required to be paid in both these scenarios. Okay, so intermediate students, just remember the section. Final students, please go in the nitty-gritties of this section and also do practical questions of this particular section. Very, very, very important. All right, guys. So the second small topic which we are going to cater to today, okay, the second topic which we wanted to touch base today was a very small topic, guys. Relief under section 89. A very small topic and a very, very easy topic. Okay, very easy topic and a very, very small topic. The name of the topic is relief under section 89. relief under section 89 is given in certain specific cases. I'll take an example of these cases. Okay, sir. Previous year 2021. We have two cases. We have 2 years, okay? And previous year 21, 22. So these are 2 years which I'm talking about, okay? I'm explaining you the concept of relief under section 18(9), okay? So there is a person, Mr. X. Mr. X has a salary of 20,000 per month. So his annual salary is 2,40,000. His salary is 20,000 per month. His annual salary is 2,40,000. In the comment box, please tell me whether the salary is taxable or not. Salary income is 2,40,000. Please in the comment box tell me whether this salary is taxable or not. Sir, slab rate is applicable on this particular salary. And if slab rate is applicable on this particular salary, then naturally, sir, the salary is not taxable. Why? Because the first slab rate is 2,50,000. If your income is up till 2,50,000, it is not taxable under the Income Tax Act regime. So yes, guys, 2,40,000 is below the taxable salary net, which is not eligible for taxation. If it is not eligible for taxation under the slab rate, then this salary is tax-free. But guys, Mr. X's salary was withheld by the employer. Employer said that I am withholding your salary. There are some disputes. Once those disputes are resolved, then we will disburse your salary. The employer of Mr. X said that I am not disbursing your entire salary to you immediately. 40,000 I am withholding back. Why am I withholding back? Because there are some disputes with respect to this salary. And once these disputes are resolved, then we will release your salary of 40,000. 40,000 was withheld by the employer. Okay, sir. Then came the next year. Next year also, Mr. X's salary was, of course, 2,40,000, which is 20,000 per month. But guys, in the next year, Mr. X got his arrears salary. Okay. What is the arrears salary? Arrears salary is 40,000 rupees. Mr. X got the arrears salary. Mr. X got the arrears salary. Arrears salary of 40,000 rupees was received by Mr. X in the next year, which was withheld in the earlier year. Arrears salary was received in the next year. Now, when the arrears salary was received in the next year, the total income of Mr. X, which was received in the next year, was 2,80,000. The total salary which was received in the next year is 2,80,000. Now, as we had studied in our salary chapter, guys, salary is taxable on receipt basis and not on accrual basis. Let me repeat. We had studied in our first chapter, guys, that the salary chapter, guys, that the salary is taxable on receipt basis and not on accrual basis. Now, if arrears are received of the previous year in the current year, then guys, these arrears will be taxable in the current year. Now, unfortunately, Mr. X will face a tax in the next year. In this particular year, Mr. X will face a tax because the salary is above 2,50,000. So Mr. X will face a tax. This is absolutely unjustified. Absolutely unjustified. Why? Because this particular tax which Mr. X will have to pay, this is not because of his salary being taxable. This is because of the timing difference in receipt of the salary. This tax which Mr. X has to pay, whatever minimal amount of tax which Mr. X has to pay, this amount of tax is not because Mr. X's salary is taxable. It is because of the timing difference of Mr. X's salary. And this timing difference is leading to taxability of salary of Mr. X. Now, this is a big problem. This is a problem which is there in the Income Tax Act. Mr. X is saying, no, I don't want to pay tax because my 40,000 rupees which you are taxing in the current year, it is not actually taxable in the current year. It is actually taxable in the previous year. This is my previous year's salary. If you exclude this, then I have salary of 2,40,000, which is again below the exemption limit, so I'm not eligible to pay any taxes. Now guys, to curb this problem which is arising due to timing difference of receipt of salary, section 89A has been introduced, which will tax the which will provide relief to the people whose salary is being taxed in this particular way. So this is the relief which is provided in a section 89 to provide relief to people who are getting taxed because of this timing difference of salary. This is the applicability of section 89A. Now guys, you can very well tell me what will be the relief which this section will provide. Of course, the relief which this section will provide will be the relief of the tax which we will pay on this 2,80,000. Whatever tax we pay on this 2,80,000, relief will be provided. Now guys, there can be another situation. What is the situation? In this particular case, I have taken a case where the salary is below the exemption limit, but there can be a case where slab rate is changing. Okay. For example, someone's salary is 4,80,000. Someone's salary is 4,80,000. His salary was withheld in the earlier year. Okay. And his salary was disbursed in the next year. So 4,80,000 becomes 5,20,000 in the subsequent year. 4,80,000 becomes 5,20,000 in the subsequent year. This is 4,40,000 and it becomes 5,20,000 in the subsequent year. So guys, in effect, the slab rate changes. The slab changes, right? Earlier he was in the slab of 2,50,000 to 5 lakhs, right? 2,50,000 to 5 lakhs. The slab was 5% slab. And then because of this timing difference, he moved to the next slab, which is 20%. From 5% slab, he moved to 20% slab. Now guys, under this situation, there is a big loss of 15% which that particular person has to bear. Now to curb this particular situation also, section 89 is under play. Okay, sir, let's see what is the section. Yes. So whom is the section applicable to? The section is applicable to an assessee who has received arrears salary or advance salary, or he has received gratuity, commuted pension, family pension, etc. He has received gratuity, commuted pension, family pension, leave encashment, etc., etc. Plus, owing to such receipt, he is falling under a higher tax rate, higher tax slab. So owing to such receipt in the subsequent year, this particular person is falling under a higher tax rate, right? This is the case where this particular relief will be applicable. Now, what will be the relief? Relief granted will be tax on receipt basis minus tax on accrual basis. So guys, naturally there's a higher tax because of the receipt of this particular income in the subsequent year. So there's a higher amount of tax which is being paid by the assessee. So tax on receipt basis. So whatever tax is payable by the assessee on receipt basis, if the income is received by him, what is the tax which is paid by the assessee on when the income is taxed on receipt basis minus tax on accrual basis. What will be the tax if the salary is taxable on accrual basis, which is fair also. Okay, this is the fair deal. Okay, this is the unfair deal. Okay, so we'll subtract both of them, and whatever is the differential will be the relief which is granted to the assessee. So tax on receipt basis minus tax on accrual basis, that is the relief which has to be granted to the assessee. Tax on receipt basis minus tax on accrual basis, this is the relief which has been granted to the assessee, and that is how relief under section 89 will be computed. Now sir, please tell us, what do you mean by tax on receipt basis? So guys, tax on receipt basis means tax on total income including additional salary. Okay, so please see this. So the tax which is payable on 5,20,000 plus tax on total income excluding additional salary in the year in which additional salary pertains to. So tax which is paid on 5,20,000 plus the tax which is paid on 4,40,000. This is the actual tax which you are paying, okay, on receipt basis. Okay, both the years cumulatively, So tax on total income including additional salary, which is 5,20,000 in the current year, right? And in the previous year, total tax which is there on income excluding the area salary, right? So whatever tax you are actually paying minus what tax you should have paid. What tax you should have paid? What you should have paid was 4,80,000 in the current year and 4,80,000 in the previous year. This is the tax which you should have paid, right? Let's see what is the tax on accrual basis. Tax on total income excluding the additional salary in the current year. So we will exclude the additional salary in the current year and will compute the tax on 4,80,000 plus tax on total income including the additional salary in the previous year. So if we include the additional salary in the previous year, it comes to 4,80,000. So tax which is paid in the current year excluding the additional salary, tax which is paid in the previous year including the additional salary, both of them taxes are to be computed separately and they are to be added. This is the tax which should have been paid on accrual basis, and we are subtracting this amount from the tax which has actually been paid. What is the tax which has actually been paid? On 5,20,000 we have paid the taxes, and on 4,40,000 we have paid the taxes. So if we subtract both these amounts, then we come to the figure of the relief which is granted under section 89. A very logical, a very prudent section, whereby they are removing the grief which is there in the case of the assessees, that they are, because of the timing difference of their salaries, they are paying a higher amount of tax. To remedy this particular grief, the relief is given to the assessee. So it's a small section, a very easy section, and guys, don't try to ratify the formulas. Just try to understand the formulas. Don't try to mug up the formulas. Try to understand the formulas and you'll be able to absolutely do well in your examination with this respect. And a very easy section and a straightforward section. Good morning everyone, and welcome to this session of direct taxation. And today we are going to deal with certain miscellaneous topics of your syllabus, guys. These are certain topics which are relevant from an exam standpoint. They are very relevant, both for CMA Intermediate and for CMA Final students. These small topics are very relevant, very important, especially for CMA Intermediate students. There is a chapter in your syllabus which is assessment of various persons. Guys, this chapter contains miscellaneous provisions of various sections of various type of taxations, right? So this particular chapter will hold 15 marks, almost 15 marks in your examination, and for past many attempts it has been continuously coming for 15 marks or above in the examination. So this is a very important chapter which we are going to start today. Good morning Harmeet, good morning Abhishek, good morning Nikhil, good morning Rasmita, good morning Sharan, and welcome to this session of direct taxation. So yes guys, this chapter which is there in your CMA Intermediate, which is assessment of various persons, and of course it is carried forward in the CMA Final syllabus as well. This chapter holds good percentage in your examination, both from an MCQ standpoint and from objective type, subjective type question standpoint. Both the angles are very important in this particular subject, guys. So please prepare this this chapter very well, because this chapter is going to hold a good weightage in your examination. Now, this chapter is not an independent chapter. It's not something that is an independent concept in itself. Actually, it is accumulation of various small concepts. So if I were to say that this chapter is a miscellaneous chapter or a residuary chapter, the topics which could not fit in any of the chapters were moved to this particular chapter, then I will not be wrong, right? So this chapter contains many concepts which are individually independent concepts with no correlation to any other concepts. So these are independent concepts. So today we are going to delve into the first concept of your this particular chapter. The first concept is alternate minimum tax. Let me repeat, alternate minimum tax. Now, guys, due to the deductions which are taken by business entities, deductions like Section 80 deductions, Section 10 AA deductions, deductions which are resulting into the profitable income of a particular entity reducing to a very low level, right? So in such cases where your profitability reduces to a very, very low level because of the deductions which are provided by the Income Tax Act itself, in those situations, Income Tax Act asks you to pay at least a bare minimum amount of taxation. Now, sir, this is absolutely unfair. This is absolutely wrong, sir. Sir, Income Tax Act has itself given us the deductions that we are taking. We are not taking these deductions on our own. These are the deductions which are given to us by the Income Tax Act itself. So then why is Income Tax Act having a problem with it? What is the problem if our income is reducing to a very low level due to the deductions or the relaxations which are given by Income Tax Act? What is the problem with Income Tax Act? Now, why is Income Tax Act demanding a bare minimum level of taxation on such businesses or such organizations? Yes, guys, you are absolutely right. To an extent, these sections actually raise a question in our mind that Income Tax Act itself provided us the deductions. Income Tax Act itself told us to reduce our profitable income to a very low level. And now Income Tax Act itself is saying, no, 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 no. This level is too low a level. You pay a tax at a higher level. Yes, this is a dichotomy. This is a contradiction which is there. Because of the contradiction which is there in this particular section, some people say that it is an unjustified section. Some people say that this concept is absolutely unjustified. This section is nothing but tax terrorism. So income tax authorities are like terrorists. They are imposing certain sections on us. Some people term this section like that. So there are various arguments against this section, which is alternate minimum tax. But guys, the fact of the matter is that whatever you may feel, whatever you may think, this section is definitely there in your Income Tax Act, and you have to follow it. So yes, if you are claiming certain deductions which are provided by the Income Tax Act and your income falls to a very, very, very low level because of which your taxation is falling to a very, very, very low level, guys, in those cases, you need to pay a bare minimum amount of taxation on your income. You cannot go away by paying no tax or very, very low amount of tax. You cannot be freed from your responsibility by paying a very low tax. This is the background behind this section, which is known as alternate minimum tax. Guys, as the name itself suggests, it is an alternate mechanism. It is a mechanism which is a second mechanism to the main mechanism, to the normal provisions of the Income Tax Act. What are the normal provisions of the Income Tax Act, guys? Section 28 to Section 44, which is the sections for PGBP. They are the normal provisions of the Act. So this particular provision deals with an alternate mechanism of computing the PGBP income, an alternate mechanism. And this is the bare minimum mechanism. This is a mechanism which will provide you the bare minimum amount of tax which you have to pay, irrespective of the fact that your normal provision tax is coming to a very low position, is coming to a very low amount. We are not bothered about that particular normal provision. If your normal provision of tax is too low, then guys, this particular section will ask you to pay taxes at a bare minimum level. This is the concept of alternate minimum tax. So yes, let's start the provisions of alternate minimum tax. A very, very important concept which is there. Provision which is with respect to alternate minimum tax. Okay, alternate minimum tax, section 115 JC 2. This section is dealing with alternate minimum tax. Now, first of all, to whom is this section applicable? Who is covered under periphery of this particular section? This section is applicable to individuals, HUF, AOP, BOI, AJP. You know about all these assessees which are there under the Income Tax Act. Individual, HUF, AOP, BOI, AJP, who are having their adjusted total income of more than 20 lakh rupees. So the Income Tax Act is not wanting to cover under its periphery the small fishes. They want the big fishes. They want the biggies. So the people whose adjusted total income is above 20 lakh rupees, only those are required to pay alternate minimum tax. If your adjusted total income is below 20 lakh rupees, then guys, you are not required to pay alternate minimum tax. You will be paying the taxes under the normal provisions of the Act, which are section 28 to section 44, even if that falls to a very, very low level, even if it falls to a 0 level, you have to pay taxes according to the normal regime if your income is below 20 lakh rupees. Secondly, this section is also applicable to all other assessees other than company. Sir, what all assessees are falling under this category? Guys, partnership firms, LLPs, local authorities are falling under this particular category. So, particularly partnership firms other than companies. So company is not categorized over here. So partnership firms are eligible to pay AMT under this particular clause. Now the catch is, guys, partnership firm, even if their adjusted total income is below 20 lakhs, then also it is required to pay AMT, alternate minimum tax. A partnership firm whose adjusted total income is below 20 lakhs, that is also required to pay AMT, because the condition of having a adjusted total income of above 20 lakh is only applicable for individual HUF, AOP, BOI, AJP. So for rest of the categories, 20 lakh limit is not applicable. So in case of a partnership firm, even if its adjusted total income is below 20 lakh rupees, that partnership firm is eligible to pay alternate minimum tax. That is the connotation which is derived out of this particular provision. Now, sir, there's a big question in our mind. The question is, Harmeet Singh is saying, Harmeet Singh has got a very good, interesting comment. So I've displayed the comment on the screen, guys. Please read Harmeet Singh's comment. Harmeet Singh saying, alternate minimum tax is equal to paise nikalo, humko desh chalana hai. This is interesting, Harmeet Singh. This is a very interesting comment, actually. All right. So the alternate minimum tax is applicable to partnership firms, even if their adjusted total income is below 20 lakh rupees. If the adjusted total income is above 20 lakh rupees, then in case of individual HUF, AOP, BOI, AJP, you are required to pay alternate minimum tax. Now, the question is, sir, why is a company out of the purview of such an important section? This is such an important section, guys, from a government standpoint, from government's point of view. This is such an important section. Then why are companies out of this section? Why are companies not covered under this particular section? That is the question which is boggling in our minds. Guys, the government is not so kind towards companies. There is a separate section which is MAT, minimum alternate tax. And that particular section is applicable to companies. So for companies, there's a different mechanism. There's a different section which has been introduced to ensure that companies pay a bare minimum amount of tax also. And that section is MAT, minimum alternate tax. And that minimum alternate tax is applicable on companies. So don't think that companies are out of purview of MAT, of AMT. Companies are also in purview of this particular cruel section, but in form of MAT. Now, please note, for CMA Intermediate students, they only have AMT in their syllabus and not MAT. Only AMT is there in their syllabus for CMA Intermediate students. But for CMA Final students, they have both AMT as well as MAT under their purview and in their syllabus. For CMA Final students, they have both MAT and AMT in their syllabus. Please note this fact. For CMA Intermediate students, they only have AMT in their syllabus. This is a difference which is there. So please study accordingly. All right, sir. Now, the second condition which needs to be satisfied is that we need to have the applicable assessees who have claimed deduction under section 80H to 80 RRB except 80P or section 10AA or section 35D. So we need to have assessees who have claimed deduction under section 80H to 80 RRB. These are the sections under which the assessee should have claimed a deduction, right? Except 80P. So even if you have claimed deduction under 80P, then this section is not applicable to you. This section is applicable to you only if you have claimed deduction under 80H to 80 RRB. Or you have claimed deduction under section 10AA. Or you have claimed deduction under section 35AD. And guys, owing to these deductions, these are heavy deductions. Do you remember what is 35AD? Sir, capital expenditure for certain businesses was allowed as a deduction in year 1. full deduction was allowed instead of depreciation. Full deduction was allowed for capital expenditure. Such a huge deduction, such a huge benefit was offered under section 35 AD. So these are the sections where huge benefit is offered to the assessee, owing to which the profit of the assessee has been reduced to a bare minimum level, to a very low level, and that is the advent of, that is the germinating point of this concept called alternate minimum tax. So yes, if you are falling under any of these categories and you have claimed deductions which are categorized like this, then guys, you are required to test whether you are required to pay alternate minimum tax or not. Sir, what is the tax rate which is applicable for alternate minimum tax? How much tax should be paid in case of alternate minimum tax? Yes, guys, let's come on to the tax liability in case of alternate minimum tax. So the tax liability in case of alternate minimum tax is higher of the two things, normal tax liability or 18.5% of the adjusted total income is required to be paid to Government of India. So what do you mean by normal tax liability? Guys, normal tax liability means the tax liability which is computed under section 28 to section 44. PGBP sections, the normal tax liability which is computed using the PGBP sections. First you need to compute that. Then you need to compute 18.5% of the adjusted total income. So what is adjusted total income? We will just now come to that. What is adjusted total income? But here you need to compute the normal tax liability. And guys, let me remind you, the normal tax liability is above 20%, okay, at least above 20%, which ranges 25 to 30% for companies. For partnership firms, it's 30%. So usually the normal tax liability is computed at 30% of the taxable income. But of course, guys, the taxable income in this particular case will be very low, because you have claimed huge deductions under the Income Tax Act, under the sections which we have just now studied. So you have claimed deductions under 80H, 80 RRB, 10A, 35 AD, because of which your taxable income is too low. When your taxable income is too low, then 30% of that taxable income is also too low. So this amount is pretty much low. Because this amount is pretty much low, resultant the resultant computation is that 18.5% of ATI is a higher amount. When 18.5% of ATI is a higher amount, then guys, the tax will be levied at 18.5% of the adjusted total income. So whichever is higher, we'll take whichever is higher. Now the catch is, in this particular case, taxable income is really low. Because of what? Because of deductions that Income Tax Act has given you. While computing the income over here, the term which I've been using, adjusted total income, while computing the income over here, guys, I will not give you the deductions which are eligible to be given to you under these sections. Under these sections, I will not give the deductions to you. And that is why the ATI, the income over here, will be considerably high. The income here was considerably low, but income over there will be considerably high. And that is the precise reason why 18.5% of this income will be higher than 30% of the income which is calculated over here. That is the precise reason, guys. Over there, I will withdraw all the deductions which have been given to you and then compute 18.5% of that particular income. Right? Now, do you understand why this can be higher? Why can this figure be higher? Do you understand that? Yes, sir. Or 9% of adjusted total income in case of IFSC deriving income in foreign exchange. So if you have your organization under the International Financial Service Center, which is specially established for overseas companies to establish their subsidiaries in India for doing their back-end financial services work. If you have your company located over here, if you have your entity located over here, then the AMT is only 9% of ATI, adjusted total income, 9% of adjusted total income. So yes, we are going to compute the normal tax liability with 18.5% of adjusted total income. Whichever is higher, that will be the amount of tax payable by you. So now, sir, the question arises, what do you mean by adjusted total income? What do you mean by adjusted total income? Guys, adjusted total income means the total income, and we'll add all the deductions on in this total income, deductions which we have allowed under section 80H to 80 RRB except for 80P. Then we are going to add deduction under section 35 AD. So guys, you have already reduced the deductions while computing this particular income. This is the total income after the adjustments, after the deductions. This is the total income after the deductions. Now I'm asking you to neutralize the effect of deductions and add back the deductions. So you first of all add the deduction under section 80H to 80 RRB. Then you add deduction under section 35 AD. Then you add the third deduction, deduction under section 10 AA. After adding all of these three deductions, you'll get to a figure of adjusted total income. In short, it is known as ATI. In short, this income is known as ATI, adjusted total income. Now guys, adjusted total income will then be subject to 18.5% of tax rate. Now, there is a small catch over here. Please observe this word, less depreciation. Sir, why is this particular amount reducing depreciation? Why is depreciation being reduced from this particular figure? You are adding the deduction under section 35 AD, but why are you reducing the depreciation? This we didn't understand. Guys, the reason is very clear. 35 AD allows you to deduct capital expenditure which you have incurred for your business in the first year of business, first year of revenue cycle, first year of profit and loss account. You are allowed to fully charge off your capital expenditure in the P&L account, right? Now, under the provisions of adjusted total income, I'm asking you to charge back that deduction. I'm asking you to draw back that deduction. When I'm asking you to draw back that deduction, naturally you will ask me that, sir, if you are drawing the deduction back, at least give me depreciation. At least give me section 32 eligibility. 32 depreciation is at least eligible, sir. So if you are withdrawing my entire capital expenditure, you have while computing total income, I had reduced the entire capital expenditure. You are saying, no, you should not reduce this entire capital expenditure. You are asking me to withdraw that. So I'm adding back the capital expenditure. I understand, sir. We understand very well. But sir, if you are asking us to add back the capital expenditure, entire capital expenditure, then sir, you should at least allow us the normal depreciation under section 32, which is allowed to us. So please allow that. That is the logic why we reduce the depreciation while we add back the main amount of capital expenditure. We reduce the depreciation because if deduction was not available to the assessee, then assessee would have at least claimed the depreciation on these assets. If the deduction was not available to the assessee, then the assessee would have at least claimed the depreciation on these particular assets. So these depreciation is reduced while computing the while adding back the deductions. That is the logic behind reducing the depreciation. So you add the deduction under section 35 AD and you reduce the depreciation which is eligible to the assessee. हाँ मेघा, वो एलिजिबल है 35 AD का, जिसने क्लेम किया है डिडक्शन वो एलिजिबल है AMT पे करने के लिए. उसे एलिजिबल, उसे AMT पे करना पड़ेगा, टेस्ट करना पड़ेगा कौन सा हायर है, AMT वाला अमाउंट हायर है या नॉर्मल प्रोविजन वाला अमाउंट हायर है, और वो ज्यादा वाला टैक्स भरेगा. सो 35 AD जिसने क्लेम की है वो AMT एलिजिबल होगा. उसे चेक करना पड़ेगा कि AMT में उसका टैक्स ज्यादा आ रहा है या नॉर्मल प्रोविजन में टैक्स ज्यादा आ रहा है. All right, and the last thing which we need to discuss now is tax credit of AMT. Now, please understand this concept, and I'll explain this concept using an example with you. Now we are dealing with the concept of credit of AMT. So, financial year 2021. Financial year 21-22. So guys, these are two financial years which we are bothered about, which we are taking under consideration. Okay, these are the two financial years. Now, normal provisions and AMT provisions. So guys, in year 1, the tax liability as per the normal provisions is computed as 1,50,000 rupees, and AMT liability is computed as 2 lakh rupees. So in year 1, the normal provisions of the act tells you that you have to pay a liability of 1,50,000 rupees. AMT tells you that the liability is of, we will take deduction of depreciation. Yes, yes, happy talwar, we will reduce the depreciation. If we have withdrawn the 35 AD deduction, then we will reduce the depreciation of those assets. 32 section 32 depreciation WDV method will reduce it. Sharan says deduction add back nahi hoga, but 35 AD wala amount to karenge na. अरे शरण 35 AD वाला डिडक्शन ही तो एड बैक होगा. अरे मेघा तोमर, तुम क्यों कंफ्यूज हो रही हो? मेघा तोमर, डिडक्शन अलाउ करेंगे 35 AD वाली, डिडक्शन जब अलाउ करेंगे 35 AD वाली तो टोटल इनकम निकल के आएगी. उसके बाद 30 AD वाली डिडक्शन को विड्रॉ कर लेंगे एड बैक करके, डिडक्शन को एड बैक कर देंगे, क्योंकि एडजस्टेड टोटल इनकम में कोई भी डिडक्शन नहीं देते. एडजस्टेड टोटल इनकम का मतलब इनकम विदाउट डिडक्शन, डिडक्शन हटाओ. इनकम टैक्स एक्ट कह रहा है डिडक्शन हटाओ, उसी ने दी वही कह रहा है हटाओ. दैट इज द रीजन. ओके ओके, सो गाइस प्लीज टेल मी, what is the tax liability of this particular person in financial year 2021? Please write in the chat box. Please write in the chat box what is the tax liability of this particular person. What is the tax liability of this particular person? Please tell me. In financial year 2021, what is the tax liability of this particular person? Yes, Karan is absolutely right. Karan is absolutely right. What is the tax liability in financial year 2021? That is my question. Please answer in the comment box. And yes, guys, please hit a like button to this video. Likes are very, very important for me. I know you might feel that, sir, oh, like is such a small thing, such a trivial thing. But it's very, very important from me. From my angle, please understand, it is very, very trivial. It is very, very important. Okay. Yes, Yashika, Happy Talwar, Junaid, Anshika, Yashika, Anshika, Anupam, Megha, Sarneka, Nikhil, Om, Ishita. Very, very right. You all are very, very right. The tax liability will be 2 lakh rupees. 2 lakh rupees you have to pay to Government of India. Now, please tell me. The normal provision was 1,50,000. You were actually eligible to pay 1,50,000, but you had paid because of the injustice done to you by the Income Tax Act. You have paid 20 lakh rupees. So, how much amount you have paid extra? You have paid 50,000 rupees extra. You have paid 50,000 rupees extra. So if you have paid 50,000 rupees extra, you will be allowed to carry forward this 50,000 rupees in the subsequent year. You will be allowed to carry forward this 50,000 rupees in the subsequent year. What will happen in the subsequent year? In the subsequent year, you will again try to find out what is your tax liability. In the subsequent year, you will try to find out what is your tax liability. So in the subsequent year, your tax liability will be again computed using the same mechanism. You will compare your normal provisions with your AMT provisions. Now, please answer in the chat box, what should be the tax liability in the subsequent year? Please note, normal provision tax is a higher amount. Normal provision tax is a higher amount. Normal provision tax is 2,50,000. AMT tax is 2,20,000. Normal provision is a higher amount. What should be the tax liability? Higher of these, the ideal tax liability which should be paid should be 2,50,000. Should be 2,50,000. Ankit Tripathi, very good answer. Ishita, very good answer. Yashika, wrong answer. Harmeet Singh, correct answer. Shipun, correct answer. Sarneka, correct answer. Om, correct answer. Rani, correct answer. Perfect. So guys, your ideal tax liability will be 2,50,000. Why? Because your normal tax liability is higher this time. So guys, Government of India is saying, whenever in the subsequent year, if your normal tax liability is a higher amount and your AMT is a lower amount and you are paying taxes under the normal provisions of the Act, then we will give you credit of the extra AMT which you had paid in the earlier years. We will give credit of the extra AMT that you have paid in the earlier years from the normal provisions of tax, from the tax which is paid as per the normal provisions. But we will give you this particular amount subject to one condition. Sir, what is that condition? Condition is that, okay, if I deduct 50,000 from 2,50,000, what will be the resultant figure? It will be 2 lakhs. And guys, It will be lower than your AMT amount. Your AMT amount is 2,20,000. It will be lower than your AMT amount. So Government of India is saying, yes, we are going to give you credit of your extra AMT paid in the earlier year, but only to the extent of amount which will result into your tax liability up to AMT. We will not give you credit of entire 50,000. We will only give you credit up till 2,30,000. We will give you credit up till 2 lakh. We'll give you credit of only 30,000. So your net tax liability cannot fall below AMT. Your net tax liability cannot fall below AMT. So what is your tax liability in year 2? It is 2,20,000. 30,000 rupees of credit is granted from 2,50,000. So what will happen to 20,000? 20,000 remains over here. Guys, 20,000 will be carried forward to the subsequent years. It can be adjusted against subsequent years normal tax slab payable. So yes, credit will be given to you in the subsequent period where your normal provisions tax is higher amount, but only to the extent of amount till AMT. You cannot pay taxes below AMT. You have to pay taxes at least till AMT. So 30,000 is allowed as a credit. 2,50,000 minus 30,000. 30,000 allowed as a credit, and the balance amount is payable to Government of India. So the tax paid should not be less than value of AMT. AMT is 2,20,000, so tax paid is 2,20,000. This was the provision of credit of AMT. Credit of AMT. This is how credit of AMT will be taken in these situations. Okay, sir, got it? So yes, guys, this was the provision of AMT for all of you. A pretty simple and a straightforward concept, guys. It's not that complicated. Some students feel that, sir, it's very, very complicated. No, guys, it is not very, very complicated. 30,000 credit. Yes, Junaid, 30,000 credit. How many years we can carry forward? 15 years. The credit can be carried forward only till 15 years. Yes, absolutely. So Pawan Chaudhary, even if you are a Hindi medium student, then I'm sure you will be able to understand English. I'm just making you understand the concepts. If you are able to understand the concepts well, then you can easily convert them into Hindi. So that is not a problem. Again, we get the yes. On the WhatsApp group, I will share these notes with you. All right. Next topic, a very, very important topic, and from CMA Intermediate perspective, guys. MTP contained a question from this particular topic, the MTP which has been released by the Institute of Cost Accountants of India, that contains a question on this particular topic. And guys, in the examination, this particular topic and cooperative society topic and AOP BOI topic, there's a high probability that they can come in your examination. Okay, so these are few very, very important topics of your syllabus. Please mark very, very important against this particular topic. This topic is very, very important. Please mark very, very important against this particular topic, guys. Okay. Political party. What do you mean by political party? Guys, political party means organization or a accumulation of people which is created for pursuing some political agenda, right? Like we have many political parties in our country: BJP, Congress, Trinamool Congress, AAP, Aam Aadmi Party, etc., etc., etc. So these are all examples of political party. Now, what is the business of political party? What do political party do? Political party receive donations or contributions from people across the nation. They fight the elections and they try to win the elections. This is the broad level of activity which is done by political party. So the political party are not into some kind of profit generating business. Their objective is to pursue their public interest goals. Their goals are to serve the public. And for fulfilling those goals, they get donations from people, they get contributions from entire the country, the people, and they pursue their goals. They don't do any business, they don't do any profit generating business, and they fight elections, they do public welfare, etc., etc. All these things are done by a political party. That is the activity surrounding political party. Now, considering that political party is not doing any profit generating activity, the entire income of political party is exempt. Now, sir, suppose a political party does some profit generating business. Then, guys, that particular business will be taxable. Simple as it is. So, any income generated by a political party owing to house property, owing to capital gain, owing to income from other sources, or any voluntary contribution which is received is exempt from tax. The only income which is taxable in hands of a political party is PGBP, and the exemption which is given for all these incomes is given under section 13A. That is the condition. Now, guys, sometimes in garb of these voluntary contributions, some malified things also are done in political party. Sir, what kind of malified things can be done? What kind of wrong things can be done in a political party in garb of this voluntary contribution? Guys, some people contribute to political parties on an anonymous basis, which means they don't disclose their names, they don't disclose their identities, but they supply some money to political party. So you must have heard that some political party is funded by underworld dons, underworld terrorists fund some political parties. So some kind of suspicious activity happens behind the voluntary contributions received by a political party. And since these voluntary contributions are absolutely tax free, the political parties are not in tension. They receive crores and crores and crores of rupees saying that it is voluntary contribution, but the purpose of receiving that money might not be correct, might be against India, might be against the purpose for which political party is created. Therefore, for voluntary contributions and donations, there are certain strict conditions which have been imposed under the Income Tax Act if the political party wants to claim exemption under section 13A. What are those conditions? The conditions are: full records, complete records of each voluntary contribution or donation above rupees 20,000 should be maintained and furnished by the political party to the Election Commission before filing the return of income. Condition number 1. For any donation which is more than 20,000 rupees, political party has to maintain complete records. They have to maintain complete oh wow, Junaid Alam, thank you so much. Junaid Alam. Junaid Alam is requesting his friends to hit a like button. हरमीत कह रहा है सर आपने किसको वोट दिया था दिल्ली के लिए? हरमीत, दैट्स अ सीक्रेट. वोट कभी किसी को बताते नहीं है. Okay. So donations which are received for more than 20,000 rupees, they are to be received with full records. Name, PAN number, address, mobile number of the particular donor should be there with the political party, and it should be furnished with the Election Commission so that we are aware who's funding this political party, who is the person behind this political party. Is it an underworld don, or is it some bona fide, some respectable people? Next, donations for more than 2,000 should only be received through bank. There should not be any cash transaction above rupees 20,000. Donation should be at most it can be up to 2,000 rupees can be cash, but beyond 2,000 rupees it has to be received through bank. That is a requirement, because guys, bank entries can be traced back. Bank entries can be traced to the person who's donating the amount. So this tracing is very much important. Therefore, the donation should be done through bank or any other e-transfer channel, not only through bank, but any other online transfer mode, e-transfer mode, or any other mode, the donation should be made, right? Next, books of accounts are required to be maintained. Proper books of accounts. Where is money coming from? Where is money being spended? What are the expenses of a political party? What all objectives has the political party fulfilled? What are the objectives which are fulfilled by the political party? All these things are to be maintained under books of accounts. So books of accounts are required to be maintained. Then last is audit is required to be done. Audit by a chartered accountant is required to be done for the books of accounts of political party. If any of these conditions are not fulfilled, then exemption is withdrawn and entire income will be taxable under the Income Tax Act. And no political party would want to do that. All the income will be taxable in hands of the political party. Section 13A exemption will be withdrawn. So that is the concept of political party. Yes, only one income is taxable, the income from PGBP. So salary is also missing from this definition. So is salary also taxable? Guys, salary income cannot be earned by a political party. There's no situation where political party can earn a salary. So that is out of question. Okay, sir, got it. All right, now we start Again, an important topic of your syllabus. Commands a good weightage in your examination. Topic is taxation of cooperative society. Now, first of all, please understand what is the meaning of cooperative society. हरमीत, अनलॉफुल तो होता है, लेकिन पहले क्या होता था, पॉलिटिकल पार्टी डिस्क्लोज ही नहीं करते थे कि कहां से पैसा आ रहा है. करोड़ों रुपए पॉलिटिकल पार्टी के पास आता था, लेकिन वो डिस्क्लोज ही नहीं करते थे. वो कहते थे, अरे भाई हमारे पॉलिटिकल पार्टी के गेट पे ना कोई बोरी भर के कैश रख के चला गया. इस तरह की बातें करते थे. तो पैसा कहां से आ रहा है ये पता ही नहीं लगता था, डिस्क्लोज ही नहीं करते थे वो लोग. इसी वजह से ये सिचुएशन बनी जहां पर उन्हें मैंडेटरी कर दिया गया कि इलेक्शन कमीशन के सामने उन्हें डिस्क्लोज मैंडेटरी करना पड़ेगा कि ये पैसा कहां से आया. अगर वो डिस्क्लोज नहीं करेंगे तो फुल्ली हम टैक्स कर देंगे उनकी इनकम को. दैट इज द रीजन. All right, so now we start our next topic, and the next topic is cooperative society, a very, very important topic of your syllabus, guys. Again, MTP of CMA Intermediate contains one question from this particular topic, cooperative society, and I feel that in the forthcoming examination, a question from at least this cooperative society or political party or AOPBOI is definitely going to be there. It is my gut feeling, and teacher's gut feeling is never wrong, guys. It is usually never wrong. Usually it is correct. Okay, so very, very important topic, cooperative society. Now, what do you mean by cooperative society? For understanding the meaning of cooperative society, you need to understand the meaning of cooperation. The word cooperation means it is accumulation of people for mutual help. People wants to help each other, and with that objective people form such a society which is known as cooperative society. Sir, please give us an example of a cooperative society. Yes, guys. So, guys, there's a very big village in Haryana, and that particular village is having a lot of farmers. They grow wheat in their farms, and they sell those wheat in market. Okay, there are a lot of farmers. Okay, so for cultivating wheat, they need seeds. Okay, they need seeds. They sow seeds in the earth, the soil, and then they reap wheat. Okay, now to buy those seeds, each of the farmer has to go to market. They have to go to Delhi. They have to come to Delhi to purchase these seeds. Okay, they purchase these seeds and they go back to their village and they sow these seeds and they harvest a good crop. In this entire process, these farmers pay a huge amount for buying the seeds. So farmer A will go to the market. He will pay, say, 20 rupees per kg for seeds, and suppose he wants 20 kgs of seeds. Okay, he buys 20 kgs of seeds, come back home and then use it. Farmer B goes to market. Again, he wants, say, 15 kgs of seeds. He buy 15 kgs of seeds and come back. Farmer C goes again to market, go to the market, purchase seeds and come back. Okay, in a similar fashion, each of the farmer of that particular village go to market and purchase seeds. Now, guys, tell me something. If all these farmers form a collective means what? If they all join hands and they decide to purchase their seeds together, the entire village decides to purchase the seeds together. All of them decide to purchase the seeds together. Then, guys, would the seed be purchased at a lower cost, at a lower price? Would they be able to bargain more? So, buying 20 kgs of seeds versus buying 1 quintal of seeds, would the price be same or would the price be low? Please answer in the comment section. Please write in the comment section. So Harmeet is saying, sir, बाकी chapters के लिए भी gut feeling जाहिर कर दो. ठीक है Harmeet, done. Within next 2 weeks, I will share my gut feeling for all the chapters. Okay, sure. I will say. Okay. Will the price be low or will the price be high? If all the farmers go and buy 1 quintal of seeds from market, of course, guys, the price will be low. So if all the farmers decide to join hands, they form a collective, they form a cooperative, and they do businesses together, they do some activities together, then definitely they will have a more bargaining power and they will have more profits. So this is an example of cooperative society. Similarly, guys, if all the farmers decide to join hands while selling their goods also, So when the crop is harvested, then they have tons and tons of wheat in their village. All of them decide to cooperate, join hands in selling the wheat, so that they don't compete against each other. They decide to join hands and sell the wheat together. They will definitely bargain a higher price for that particular wheat as compared to what they will fetch if they go individually. Because if they go individually, then they will fight amongst themselves. They will be competing amongst themselves if they go alone. But if they go together, they will not be competing amongst themselves. They will bargain a higher price for their wheat. This concept is known as a cooperative society, where all the people join hands and for the benefit of the members, they do some certain activities. This is known as cooperative society. Now, considering that cooperative society considering the cooperative society is there for benefit of the members, the tax rates which are eligible for a cooperative society are very, very, very low. So guys, these are the tax rates of cooperative society. Up to 10,000 rupees, 10%. Next 10,000 rupees, 20%. And above that, 30%. So there are certain basic exemptions which are given to cooperative society. Rest income is taxable at 30%. Now, sir, this we understood that, sir, the tax rates are these. But sir, these are not lower tax rates. These are tax rates which are eligible to any person. How is the benefit given to cooperative society, sir? How is this a benefit? This is not a benefit, sir. This tax rate is applicable to everyone. How is this a benefit? Guys, the benefit which is extended to cooperative society is in the form of non-taxability of certain income. Non-taxability of certain income. So if cooperative society is carrying on these activities, then they don't have to pay any tax. That is the benefit which is derived by a cooperative society under the Income Tax Act. This is the benefit. Benefit is not lower tax rate, because tax rate is not lower. 30% is lower, not at all. But what is the benefit? Benefit is that if they do certain specific type of activities, then their income will be allowed as a deduction under section 80P. Their entire income is allowed as a reduction. No taxes to be paid on these activities, on these incomes. What are those incomes, sir? Let us understand. So there are certain specified activities on which income tax is exempt. Then interest dividend from another cooperative society, if the cooperative society is earning interest or dividend from another cooperative society. So for example, cooperative society 1 has got some surplus amount and it invests in cooperative society 2. Okay, and it receives some interest from cooperative society 2. Then the income which is earned by cooperative society 1, that income is free from tax. Interest dividend, you don't have to pay any tax. But interest dividend should be earned from another cooperative society. It should not be earned from another company or another organization altogether. Okay, it should be earned from another cooperative society. And the third income which is exempt from taxes, income from letting out of godown, warehouse, etc. So wherever godown or warehouse is let out by a cooperative society for the purpose of marketing of goods of the members, then guys, that income is also exempt from tax. So big benefit given to cooperative societies, that their income will be exempt from taxation if they follow these activities. But if they follow activities other than these, then guys, the deduction will be limited to a very small amount. If it's a case of consumer cooperative society, then the deduction will only be up to 1 lakh rupees. And if it's any other cooperative society, then the deduction will be up to 50,000 rupees only. The entire income will be taxable, subject to reduction of 1 lakh and 50,000 respectively. That is the difference between consumer cooperative society and other cooperative society. So guys, we will always wish that our activities are falling under this category so that we get 100% reduction. Now the question is, sir, what do you mean by specified activities? What is the meaning of specified activities? So guys, the section gives you a list of activities which are categorized as specified activities. And yes, this activity, if a cooperative society is doing these activities, then it is exempt from tax. No tax is levied on the cooperative society. Activity number 1, banking activity, credit business, financing business. This is applicable for primary credit society, primary cooperative or rural development bank. So if you are in the business of providing credit finance to cooperative societies and you are a primary cooperative society, primary agriculture credit society, then guys, your income from banking business or credit business will be fully exempt. Second, if you are into cottage industry, then your income is fully exempt. If you're doing marketing of agro products produced by your members, now this is very, very important, guys. You are doing marketing for agro products produced by members. If you are doing marketing, if you're a cooperative society, so for example, the entire village is producing wheat. Now you need a marketeer to market it, to send your goods to various markets and fetch the best price. This marketing activity is done by a cooperative society, which is created by all the farmers who are of that particular village, right? So that particular marketing cooperative society should perform services only for the members and not from the non-members. If they do marketing activities for non-members, deduction will not be allowed. Only if they do marketing activities for the members, then only deduction will be allowed. This is the point to be noted over here. Similarly, guys, if purchase of seed, livestock, etc. is done for members by a cooperative society, it will be free from tax. But if it is not done by members, if it is done for non-members, if it is not done for members, if it is done for non-members, then guys, this deduction will not be applicable. Next is processing of agro produce of members without power. So if only processing is done by the cooperative society. Now, in many cases, guys, farmers do not have the ability to process their goods. So, I'll give you an example of paddy. Paddy is rice, right? So paddy is rice, and in its raw form, it is very thick rice, okay? It needs polishing to make it more marketable. Farmer is saying, I don't have any resources to polish it. So all the farmers of that particular village create a cooperative society, and the role of cooperative society is only to process the paddy to make it rice and fine quality rice, basmati rice. That processing activity of that particular cooperative society will be free from tax if it is done only for members. And one more thing, important thing to be considered is processing is to be done without aid of power. If you do processing with aid of power, power means electricity. If you do processing with aid of power, then this deduction is not applicable. If you do processing without aid of power, then this deduction is applicable. So the processing is to be done without aid of power. Then collective disposal of labor of members. So members collectively achieve some task, do some task, that is known as collective disposal of labor. So all the members of the cooperative society are engaged in, say, constructing a building, construction of a building. They work on a construction site of a building, right? This is known as collective disposal of labor. So all the members are working towards something. That skill which member is rendering, that effort, that manpower which the member is rendering is known as collective disposal of labor of members. So there's a cooperative society which is facilitating all the members in fetching good prices for their manpower, for their skills, for their efforts, and that is known as a collective cooperative society which is engaged in collective disposal of labor of members. So yes, if you are collectively disposing labor of your members, if your members are working towards something, then that is also a cooperative society. Fishing and allied activities for members. So if you are a cooperative society which is doing fishing and allied activities for your members, then that particular cooperative society is also exempt from taxation. Supplying milk, oil seeds, fruits, vegetables grown by members of primary cooperative society to federal society, government, local authority, or government company. Now, suppose if you are a cooperative society which is engaged in procuring milk from the members, milk is derived by the members by the livestock which they have in their home. You are procuring the milk from the members, and then you are supplying the milk to federal societies. Federal societies are societies which are at a state level, working at a state level. They collect milk from all the societies which are working at village or taluka level. Okay. Federal society is topping it all. Federal society is a society which is working at a state level. They collect milk from the individual cooperative societies and they further sell milk. So if you are a cooperative society which is selling milk to federal society or to government or to local authority or to government company, then you are also eligible for this particular deduction. So guys, these are the primary activities which you should carry on to claim 100% deduction of your income. Now, last point, and a very, very important point, guys, in these two cases, where you have a cooperative society for collective disposal of labor, or you have a cooperative society for doing fishing and allied activities. Either you have a cooperative society for collective disposal of labor, or you have a cooperative society for fishing and allied activities. If you have cooperative society for these two activities, then guys, that particular cooperative society should give voting rights only to following people to claim the deduction. That cooperative society should not give voting rights to any third party. In these two cases, the cooperative society should give voting rights only to the individuals who are contributing to labor or fishing or allied activity, to the members who are actually performing the work, right? Or to society who's providing credit or financial assistance to this society. So any society who's providing loan to this particular society, these two societies, okay, these are the two categories. So if any other society is there who's providing loan to this particular society, then that society can be a voting right member of this particular society. Or any state government can be a member of it can hold voting rights of these two cooperative society. In a nutshell, it means for these two cooperative society, if you have any shareholder of cooperative society who is an outside party, who's not doing anything in your cooperative society except for state government, who doesn't have any role to perform in your cooperative society except for state government, it's a third party, then your deduction will not be allowed, even if you are carrying fishing activity, even if you are carrying collective disposal of labor of members, even if you are carrying these activity, but your voting rights are given to some third parties who are managing your cooperative society, then guys, the deduction will be withdrawn. The deduction will not be there. This is a very minute point which is to be considered. Very minute point to be considered over here, especially for these two kind of businesses, only for these two kind of cooperative societies. The voting rights should be there only with the individuals who are actually working, who deserve profits of these cooperative societies, or the people who have given credit, the other cooperative society who have given credit or loan to this cooperative society, or any state government can hold the voting right. No one else can hold voting rights under these two cooperative societies. That is the provision. So yes, that was the provision of cooperative society for all of you. I have already discussed the tax rates. The tax rates of cooperative society is basic slab rate is there up to 10,000, 10%, next 10,000, 20%, and for balance income is 30%. Health and education cess is 4%. 4% is health and education cess, and surcharge is 12%. So these are the tax slab rates which are available for a cooperative society. That is how cooperative society tax slab rates look like. All right. So guys, this was the section on cooperative society. We have covered 3 sections today. Number 1, AMT. Number 2, political party. Number 3, cooperative society. Okay. Yes. Good morning, everyone, and welcome to this session of the assessment procedures. Welcome to this session of one of the most critical chapters of your syllabus. Yes, entirely a theoretical chapter. No practical questions, no calculations, no mathematics, nothing at all. Nothing at all. We just have to discuss some theoretical concepts, and yes, the most important theoretical concepts of not only CMA Intermediate, but also of CMA Final. Yes, CMA Final students, you should also gear up, especially the reassessment proceedings, section 148. Very, very important for CMA Final because it has been recently amended. And today I'm going to discuss the entire amended section 148. So very, very important from CMA Final student standpoint also. So both CMA Intermediate student and Final students, gear up, because from this particular chapter, you can easily find a question worth 5 to 6 marks in your examination. So important sections which we are going to discuss today of assessment procedures. Yes. So before I start this particular chapter, let me ask you, how many of you are a diehard fan of Sunny Deol? Write in the chat box. How many of you love Sunny Deol? And if someone of you can just type some of the famous dialogues of Sunny Deol. Do you like Sunny Deol? And if you can just write down some of the dialogues of Sunny Deol. Let's see your creativity as well today morning. Yes, please confirm if you like Sunny Deol. Let's see who all students like Sunny Deol. Type a yes in the chat box. Sharan is saying not him, but his dialogues. Karthik is saying yes. Dhruv Jain is saying, ये तो मैंने dialogue दिया है, कोई और dialogue बताओ. Tariq pe Tariq, I have given you the dialogue. You tell me some other dialogue of Sunny Deol. Any other dialogue, if you remember. CMA is better. Venki Venkat is saying CMA is better. Om Kakati, yes. Om Kakati saying yes. अगर एक कागज पे मोहर नहीं लगेगी तो क्या तारा पाकिस्तान नहीं जाएगा? शरण, अमेजिंग डायलॉग ऑफ सनी देओल. वेरी गुड, वेरी गुड. ये 2.5 किलो का हाथ है कातिया. यू हैव मिक्स्ड 2 डायलॉग्स. ओके, यू हैव मिक्स्ड 2 डायलॉग्स. ये 2.5 किलो का हाथ है कातिया. नहीं, यू हैव मिक्स्ड 2 डायलॉग्स. वन डायलॉग इज ये 2.5 किलो का हाथ किसी पे पड़ता है तो वो उठता नहीं, उठ जाता है. एंड सेकंड इज ये समथिंग समथिंग का हाथ है कातिया. दूध मांगोगे तो खीर देंगे, कश्मीर मांगोगे तो डैश डैश डैश. विवेक शर्मा, अमेजिंग, अमेजिंग गाइज. Very good. You're all a Bollywood buff, huh? Yes, and his overacting is fun. So yes, guys, today we are going to discuss the Bollywood courtroom drama which you've seen in your Bollywood movies and the famous dialogue of Sunny Deol. तारीख पे तारीख, तारीख पे तारीख, तारीख पे तारीख मिलॉर्ड. मिली है तो बस तारीख, नहीं मिला है तो इंसाफ. Now, my question to you is, guys, the courtroom drama which you have seen in Bollywood, the courtroom presentations which you have seen in Bollywood, the lawyers with the long black coat, the suspense thriller movies which we have seen in our Bollywood, and CID shows like CID, shows like Crime Patrol, all those courtroom dramas, all those exciting criminal cases which the famous detectives solve and famous policemen solve. So all those courtroom drama, all that excitement, all that interesting stuff about the courtroom, about a case being held at courtroom, case being fought at courtroom between 2 lawyers on behalf of their clients, all that excitement, all that courtroom drama. Do you think that courtroom drama is prevalent in case of income tax as well? So in case of income tax proceedings, in case of income tax litigation means where cases are fought between the income tax department and the assessees. In those courtroom drama, do you think equivalent amount of excitement lies in those cases as well, as compared to the criminal cases, as compared to the cases where criminal procedures are involved or criminal activities are involved, compared to those activities or compared to those courtroom drama excitement? Do you think that even income tax act proceedings are equally exciting, are equally dramatic? Do you think that? If you think that, type a yes in the chat box. Type a yes in the chat box if you think that yes, the excitement which is there in the normal criminal proceedings is equivalent to what we get in taxation. Or type a no if you think, sir, taxation is a very dull subject, and sir, in such a dull subject, what excitement, sir? What excitement? There is no excitement, sir. Abhishek is saying, I hate Bollywood. ये मजदूर का हाथ है कातिया, लोहा पिघलाकर उसका आकार बदल देता है. हाँ, ये अभिषेक ने कॉपी पेस्ट मारा है गूगल से. बिल्कुल सही कॉपी पेस्ट मारा है. मैं तुम्हें भूल जाऊं ये हो नहीं सकता, और तुम मुझे भुला दो मैं ये होने नहीं दूंगा. पॉजिटिव वाइब्स, दिस इज रॉन्ग. This is the dialogue of Sunil Shetty. So, guys, the reality is the courtroom drama which is prevalent under Income Tax Act is much more exciting as compared to the criminal proceedings which you have seen on television. Because the courtroom drama which is existing in Income Tax Act, that is based on law, that is based on interpretation of statute, that is based on interpretation of the provisions which are written in the Income Tax Act. And guys, these provisions, when they are fought over by a very seasoned or very experienced lawyer, it is a beauty. It's a privilege to see the entire courtroom drama, to see the arguments, and to hear both the lawyers out. It is one of the most enriching experience that at least I had in my life for almost 10 years. So guys, for almost 10 years, I have worked in the litigation department of one of the big fours, and the entire litigation was dedicated to the Income Tax Act and the surrounding legislature. So I can vouch for it. I can vouch for it that the excitement and the courtroom drama that you see on television, the courtroom drama which you see for criminal cases, the courtroom drama which you see in CID or Crime Patrol, they are nothing as compared to the courtroom drama which you see for the Income Tax Act. So yes, those of you who are interested in pursuing income tax as your profession in future course of action after you complete your CMA, guys, vouch for it. Take it from me in writing. You are gonna love it. You're going to love it. If you venture into the specific field of income taxation, which is litigation, if you venture into this field of income taxation, which is assessment procedures, which direct towards or which moves towards litigation, this is the first step towards litigation. This chapter is the first step towards litigation. If you want to go into litigation, then guys, you are in for a amazing roller coaster life in your career. It will be an experience, a lifetime of an experience. I can vouch for it because for whole 10 years I was in the litigation department of one of the big four. So you are also going to love it. But the prerequisite of making a career in assessment procedures is, or the litigation, the future litigation which Income Tax Act provides, if you want to make a career in the litigation part of Income Tax Act, the prerequisite is that you need to understand, you need to delve into yourself, you need to absorb the Income Tax Act very well. No person who has lacking in knowledge of Income Tax Act can succeed in litigation of Income Tax Act, because the stepping stone of litigation is to have an in-depth analysis, to have an in-depth understanding of the Income Tax Act. So first you need to understand the Income Tax Act, which you already do. You have completed the 5 heads of income. You have completed difficult chapters like assessment of various person, minimum alternate tax, cooperative society, political party, trust, charitable trust, business trust, and whatnot. You've covered all those critical aspects of Income Tax Act. Once you have gone through all those aspects of Income Tax Act, you are absolutely ready to venture into this amazing world of assessment procedures, which will in future lead to litigation. And today we are going to start this amazing chapter known as assessment procedure. Now, first of all, let me tell you, what do you mean by assessment procedure? Okay. So what is the meaning of this word assessment? What is the meaning of this word assessment? Guys, assessment means to compute, to scrutinize, to check, to assess. That is the meaning of word assessment. Sir, who will check and what will he check? 2 questions. Who will check and what will he check? So, suppose you are a person who's a salaried person, and for the entire year you have been earning income. Okay, I'm taking a year. This is the financial year which I have taken. This is the financial year which I have taken. Okay, this financial year starts on 1st of April 2022, and this financial year, suppose it ends on 31st March 2023. This is the year under consideration. This is the year which we are talking about. Okay. So in this particular year, you have earned your income, and in this particular year, you have earned amazing amount of income, which you are very proud of. Out of your efforts, out of your hard work, you have earned income of amazing amount. Your salary is huge, and you have earned income of a good amount in this particular year. Now, I want you to answer me a question. Which assessment year are we talking about? Please answer in the chat box. Fastest fingers first. Which assessment year are we talking about? Which assessment year are we talking about? Please let me know which assessment year are we talking about. I'm talking about which assessment year over here. So the income is earned between 1st April 2022 to 31st March 2023. This is the year in which income is earned. Which assessment year am I talking about? Please write in the chat box. Kirti Batra, Abhishek, good. Kirti Batra, Yashika, Fastest fingers first. Ankit Tripathi, Mohit, brilliant. Geeka, brilliant. Renu, Sharan, perfect, perfect. We are talking about the financial year 2022-23. We are talking about the assessment year 23-24. This is the year which we are talking about. We are concerned with this particular year. We have earned huge amount of income in this particular year. We have earned income from say income from other sources, income from PGBP, income from house property. We have earned 3 sources of income. We have earned huge income in this particular year. Now, what will happen? Now, after we have earned income in this particular year, the very first step that we need to do is to file a return of income. So once the year has ended, because during the year is continuing, we cannot file a return of income because we don't know what is our income. How can we file a return of income? So what is return of income? Guys, return of income is a bureau or is a summary of all the incomes that you have earned in your concerned year, and according to you, what is the tax which is to be computed for this particular year. According to you, that is your submission to Government of India. You are saying, dear Government of India, I have earned so and so income from so and so heads, and I have to pay you taxes amounting to so and so. This is your return of income. This is your self-assessment. You are self-computing your income, you are self-computing your taxes, and you are depositing it to Government of India. Of course, for a person who doesn't know Income Tax Act, he cannot self-compute his income, he cannot self-compute his taxes, so he takes help of a cost accountant like you, CMA, or he takes help of a chartered accountant, a CA. He will take help of such professionals and he will file his return of income. But please note, return of income cannot be filed while the year is on. Return of income will be filed always when the year has ended. During your assessment year, the return of income will be filed. So return of income will be filed somewhere over here. So we have different timelines for filing the return of income. Like for individual, we have 31st July. For the companies, we have October and November. So we have different timelines with respect to filing a return of income. You will file your return of income, okay, and you will first of all compute or assess your own income. So the very first step of the assessment procedures is, I have already told you meaning of word assessment. What do you mean by the word assessment? It means to compute, to scrutinize, to check, to assess what is your income and what is your income tax. Because only and only people who are knowledgeable of the Income Tax Act will be able to do this particular task. So you have to assess, you have to know what is your income. Okay, so the very first step in the litigation process, the very first step in the assessment process is self-assessment. Is what is self-assessment? What do you mean by self-assessment? Self-assessment means when the assessee himself, who is the assessee? You are the assessee. You have earned a return of income. You have earned the income during the year. You are filing your return of income. So the first process in the litigation aspect, the first process in the assessment procedure is, you have to compute your income. You have to compute your taxes. You have to tell to Government of India, dear Government of India, I am filing summary of my income tax return. This is the income which I have earned. This is the taxes which I need to pay. The first step is known as self-assessment under section 140A. And this is to be done before filing the return of income. So before you file the return of income, you have to calculate with a cool mind, with all the details which you have in your books of accounts, with all the details pertaining to which year, pertaining to this year, you need to compile all the details. Pertaining to this year, you need to compile all the details. So what details will be required? Details like income details and detail like taxes details. You have to compile that detail and you have to file the return of income. This is how the first step is fulfilled, which is self-assessment. So self-assessment, section 140A. Before filing the return, assessee himself assesses his income. Assessee himself assesses his tax and submits it to Government of India. The return of income is submitted in the prescribed forms. There are forms. You cannot do like this, that, on a piece of paper you have written, oh, my salary is 4 lakh rupees. My income from house property is 5 lakh rupees. My PGBP income is so and so. This is the total. Government of India slab rate is applicable to me. So this is the tax. No, no, no. You cannot do this on a piece of paper. You have to do this in forms which are prescribed by Government of India. They will ask you to fill those forms which have been formatted, which format has been provided by the Income Tax Act, and you will file your return of income. That is the first assessment procedure, which is known as self-assessment. This is the first assessment procedure, which is known as self-assessment, section 140A. It is always submitted before filing the return of income. It is always submitted before filing the return of income. So this is the first step, self-assessment. Now, do you think that Government of India will be satisfied with whatever you have filed in your return of income? Or will Government of India check your return of income, your computation again? My question is to you is, do you think Government of India will be satisfied with whatever return of income you have filed in your, in that form? Will it be satisfied? Oh, yes, my assessee is very honest. My assessee is very honest. They are very honest people. They would have filed their income details absolutely perfectly. Would government assume this, or would government want to recheck the computation which you have made? Would government want to re-scrutinize the return of income bill which you have made? Would government be satisfied with your submission, with your return of income, or would Government of India want to recheck it? Answer is Government of India would want to recheck it. Whatever you have submitted to Government of India would want to assess it themselves to see whether whatever you have submitted is right or wrong. Because guys, there are a lot of people in this country who evade taxes, who earn income in crores and they show their income in lakhs, who do not show their right income for scrutiny, who compute their tax on the basis of incorrect tax rates. They apply wrong tax rates. These are the problems which our country faces. There are a lot of tax evaders. So government will never be satisfied with this assessment which the assessee has made. So beyond this point, all the assessments are the assessments which are done by Government of India. This assessment is done by the assessee, that is you, the person who's filing the return of income. Beyond this, all the other assessments are done by Government of India, because now it's Government of India's duty to check whether whatever you have submitted is correct or incorrect. बहुत नाइंसाफी है मिलॉर्ड, बहुत नाइंसाफी है. असेसी के लिए सिर्फ एक असेसमेंट का डोर ओपन है और गवर्नमेंट ऑफ इंडिया के लिए इतने सारे असेसमेंट के डोर्स ओपन है. ये देखो, इतने सारे असेसमेंट के डोर्स ओपन है. बहुत नाइंसाफी है. असेसी के लिए सिर्फ एक असेसमेंट का डोर ओपन है और गवर्नमेंट ऑफ इंडिया के लिए इतने सारे असेसमेंट के डोर्स ओपन है. नहीं भाई नहीं, ऐसा नहीं है. इट इज नॉट एन इम्पार्शियल बिहेवियर. It is not an impartial behavior. Why impartial behavior is not there? Because each of these assessments have some specific purpose because of which they are different. Each one of them serve a different purpose. There is a different purpose for each one of them. It is not that government is free to choose any one of them. No. There is a specific purpose for each type of assessment. This is a proper process which Government of India follows. And by following this particular process, Government of India ensures that the entire scrutiny assessment, the entire assessment proceedings are done in a perfect manner, are done in an appropriate manner. So don't think that Government of India has a lot of techniques by which they can assess or reassess income. All of these serve different purpose. There's a different purpose for each of these assessment. Now let's delve into the assessment techniques which are available with Government of India. Okay. First technique is intimation under section 143(1). So guys, now let me be very frank with you, okay? In country like India, where more than 150 crore people are there, And more than, I think, 5 crore people would be filing their return of income. More than 5 crore people would be filing their income. Let me get the statistics from Google, latest statistics. Let me see how many people file return of income in India. People filing a return of income in India, approximately over 5 crores. Yes, my estimation was correct. Over 5 crore people file their return of income. Okay. Over 5 crore people file their return of income. The infrastructure which is available with Government of India is not sufficient to check each and every return. There are no sufficient infrastructure. There are not enough assessing officers who can check each and every return. 5 crore, more than 5 crore, approximately 6 crore returns are filed each year. This is to be filed by each of the individual. Government of India does not have resources to check each one of the return of income. And hence, Government of India has to bifurcate all the return of income into various parts. So the first step in checking of return of income is intimation. Intimation, which is the first step of assessment procedures. This is done for 100%, almost 100% of the assessees. Almost 100% of the assessees, intimation is done. So what is intimation? Guys, intimation is a computer-based checking. It's not a manual checking. It is a computer-based checking. It is a system-based checking, just like artificial intelligence, which is applied in today's world in a rampant manner. A computer would look at the return which is filed by the assessee, and computer would pull out any arithmetical error in the return. Arithmetical error means mathematical error. So what is 2 plus 2? 2 plus 2 is 4. By mistake, some assessee has written that 2 plus 2 is 3. That is an arithmetical error. So this will be pointed out under intimation by the computer. So intimation is generated by system. It's a system generated assessment. No human intervention is there. No human being is sitting to pass these intimation orders. No human being is there for passing these intimation orders. So this is a computer-based assessment. And this, since it is done by computer, it is possible to do it for 100% of the people. So this is done by 100% of the people. But the problem is, in-depth scrutiny cannot happen in this intimation. So computer cannot ask you to, give invoices or give details of your expenditure. Computer cannot ask you. Computer cannot check in that manner that, okay, if you have claimed that I have repair and maintenance expenses of 10 lakh rupees, show me the vouchers, show me the invoices. Computer cannot say that. So this is not an in-depth calculation or in-depth checking. This is just a broad level checking. This is just an overview of, yes, there is no apparent incorrect claim. Okay. Next is incorrect claim apparent from information in the return. So for example, if a male is filing its return of income, a male person is filing its return of income, and he takes the slab rates of a female by mistake, or a senior citizen, a non-senior citizen is filing the return of income, and he takes the slab rates of senior citizen by mistake. Mistake can happen, right? So such apparent mistakes, what do you mean by apparent? Apparent means which are visible from the information itself, that yes, this person is aged 47 years. How can he apply senior citizen slab rate? So the incorrect claim which are apparent from the information can be checked by the computer using this technique known as intimation. But in-depth analysis is not possible using this particular intimation. So I cannot, ask the computer, oh, Mr. Computer, listen, please check the whether all the invoices are there for marketing expense for this particular person or not. Please check whether those invoices are fake or whether those invoices are genuine. I cannot say this thing to the computer. Computer cannot do this. At max, what can computer do? Computer can check your mathematical calculations. Computer can check your some basic apparent mismatch in the information. Like, in case of PGBP, you need to file details of your balance sheet. Your balance sheet is not tying. This can be done by a system. This can be done by computer. So first step of the assessment proceeding is done by computer, which is an intimation, but it is limited scrutiny. Limited means only a few aspects are to be considered in this particular assessment proceedings. The ultimate purpose, Nalayak Abhishek Mathur. नालायकी भरे कमेंट करता रहता है. Intimation under section 143(1). Okay, intimation is limited scrutiny of your return which you have filed. And yes, incorrect claim apparent from record from information is highlighted in the intimation. What is the last date of passing the intimation order? The last date is 9 months from the end of the financial year in which a return is made. So at max, 9 months from the end of the financial year in which return is made, the intimation is supposed to be passed. The intimation is supposed to be given. The intimation is supposed to be given at max till the 9 months from the end of the year in which return is made. So date is finalized. Intimation can be done. Intimation assessment can be done only till 9 months from the end of the financial year in which return is made. Now, guys, for every assessment proceedings, just like there is a fixed timeline for the assessee to file its return of income, similarly, every assessment proceeding has a fixed timeline up to which the assessing officer can make your scrutiny, can make your assessment. Because the government of India doesn't want the assessing officers to delay this crucial process of assessment. This is a very, very crucial process because this directly impacts revenue of the country. If someone is leaking revenue, if someone is evading tax, then that is caught quickly. Government of India wants to catch hold of the evaders very, very quickly. So these processes are all time bound. These are bound by time. So you have to follow strict timelines. Government of India has to follow strict timelines by making this assessment. So the timeline is 9 months from the end of the financial year in which a return is made. 9 months from the end of financial year in which a return is made, intimation is to be done. First assessment proceeding should be done latest by 9 months from the end of the financial year in which return is made. Now, my question to you is, what is the last date of receiving intimation in our case? Fastest finger first. Fastest finger first. What is the last date of receiving an intimation in our case? Our year was financial year 22-23, assessment year 23-24. What is the last date of receiving intimation in this particular case by Government of India? What is the last date when intimation can be received? Any arithmetical error can be pointed out by Government of India. Fastest fingers first. I want the last date up till when scrutiny of intimation can be done. Intimation under section 143(1) can be done. I want the exact date and the month, okay? And the year also, guys, year also. नालायक अभिषेक माथुर फिर नालायकी करी. हर्षद सोनी तो चैंप है भाई. दिसंबर बोल दिया. अब दिसंबर कौन सा दिसंबर नहीं पता, कौन सा ईयर, कौन सा डेट, कुछ नहीं पता. ओम ककाती का भी कुछ नहीं पता भाई, ईयर वियर कुछ नहीं पता. 31. ओ प्रशांत दुबे बेस्ट आदमी है भाई. प्रशांत खतरनाक. 31. ही सेड 31. अब 31 के आगे क्या पीछे क्या कुछ नहीं पता. गीका 30th September 2025. ध्रुव जैन 30th December 23. नालायक ध्रुव जैन. नालायक ध्रुव जैन. विवेक शर्मा नालायक विवेक शर्मा. ओम ककाती नालायक ओम ककाती. चलो अभिषेक माथुर की कम से कम पूरी डेट तो आई. पॉजिटिव वाइब्स. December 31st 2024. 31st December 2024. राजेंद्र प्रसाद वैद्या. कीर्ति बत्रा. ओहो कीर्ति बत्रा तो 10 साल बाद चली गई मैडम. कहती है 10 साल बाद डेट आएगी. 2032 गाइस. 2032 10 साल बाद डेट आएगी. वाह शाबाश. मोहित 31st December 24. गीका 31st December 25. ओके चलो एनालिसिस कर लेते हैं. सो इट सेज 9 months from the end of the financial year in which return is filed. Guys, the return is filed in financial year 2023-24. The return is filed in financial year 2023-24. 23-24, the year ends on 31st March 2024. Now counting 9 months from this particular date, April, May, June, July, August, September, October, November, December. So the last date of receiving the intimation is 2024. So the last date of receiving intimation in this particular case is 31st December 2024 because it says 9 months. Please note, please note. 9 months from the end of financial year in which return is made and not the year in which income is earned. Year in which return is made and not the year in which income is earned. Please understand this fact. So The answer is 31st December 2024. 31st December 2024 is the date when intimation is to be sent by Government of India to you. Now, please understand my question. I have a question for you. Government of India sent you a intimation on 25th January 2025 stating that there is a mathematical mistake in your computation and your tax should be paid extra. You should pay extra tax amounting to rupees 1 lakh due to this arithmetical inaccuracy. Your calculation is wrong. Intimation is received by you on 25th January 2025. Income Tax Act is saying your calculation of tax is wrong. You have to pay additional tax of 1 lakh rupees. My question to you is, will you pay this tax or not? Answer in the chat box. Will you pay this tax or not? Will you pay this tax or not? You have received intimation on 25th January 2025. Will you pay this tax or not? Is this particular intimation valid or invalid? Is this particular intimation valid or invalid? Future CMA says yes. Maybe. What is maybe? So guys, you do not need to pay this tax. You do not need to pay this tax because this intimation is void. This intimation is invalid. Since this intimation is invalid, you need not pay any tax. Intimation should have been received by you, should have been received up till 31st December 2024. 31st December 2024. समय बीत गया, बिल्कुल समय बीत गया. So this is an unethical, this is a invalid return. हमारा बस चले तो हम कभी ना दें. नालायक ध्रुव जैन, तुम्हारा बस चले तो तुम पढ़ो भी कभी ना. ये तो मजबूरी है जो तुम पढ़ रहे हो, वरना तुम घूमते रहो और इंस्टाग्राम पे घूमने के बाद अपने पिक्चर्स डालते रहो. बस यही काम करो तुम पूरी लाइफ. Okay, so this was the first scrutiny which is done by the Income Tax Act, which is intimation. Now coming on to the second scrutiny, which is the main scrutiny, scrutiny assessment under section 143(3). Now guys, this particular scrutiny is an in-depth scrutiny. In-depth means what? In this particular scrutiny, a proper manual scrutinization will happen. Manual scrutinization means there will be a human being, there will be an income tax officer who will be looking at your return of income, who will be asking you certain questions, who will ask you where have you earned the income, who will ask you how have you computed the tax, who will ask you please show me the vouchers, please show me the invoices, please show me the every detail which you have. He will after asking all these questions, he will do your scrutiny. So this is the in-depth scrutiny. This was not the in-depth scrutiny. This was only the scrutiny with respect to limited aspects like arithmetical error or incorrect claim apparent from record. This was limited scrutiny. Since this was limited scrutiny, it was done for all the people who filed the return of income. But can you guess? Can you guess how many people face scrutiny assessment in percentage terms? How many people face scrutiny assessment in percentage terms? Please guess. Please guess how many people face scrutiny assessment in percentage terms. I have a rough figure in mind, but I'm just confirming it using Google. People facing scrutiny. Can you guess what is the percentage of people who are facing scrutiny assessment? Out of the 5 crores and 6 crore people, okay? Out of the 5 to 6 crore people, how many people are facing scrutiny assessment? How many of them face scrutiny assessment? No guys, all of you are wrong. The answer is even less than 1%. Even less than 1%. Maximum 1%, not more than that. There is no infrastructure in the company to have scrutiny, detailed scrutiny of entire 5 lakh people, 5 crore people. There is not infrastructure there in the country. So at max, only 1% people face detailed scrutiny procedure, which means a manual person, assessing officer, will actually look at your return of income, More than 90%. Sharan, no, not at all. How can it be more than 90%? Only 1% people face scrutiny assessment. So in-depth scrutiny is faced by 1% of the total people. This is done for 100% of the people, but this is done only for 1% of the people. In-depth scrutiny is done. Scrutiny under section 143(3) is done. Now, before a scrutiny is done for any person, a notice is required to be given to that particular person, intimating him that you are the lucky one. Yes, you are the lucky one for whom detailed scrutiny will be done. You are amongst the 1% of the lot. You should be happy to know that you are so lucky that your scrutiny assessment will happen. So, first of all, a notice is required to be given under section 143(2) for making this scrutiny assessment to the person who's selected for scrutiny assessment. So, how do they select people for scrutiny assessment? What is the procedure that they apply for selecting people for scrutiny assessment? Guys, the procedures are many. Okay, they see certain ratios. What is your gross profit ratio as compared to previous year? How much taxes have you paid? Have you paid less taxes than your previous year taxes? Now, what is the growth in your business? What are the cash payments, bank payments, bank receipts which you have done? How many foreign trips have you made? You are flying outside India very frequently. How many world tours have you done? How many gold purchases have you done? Expensive things that you have purchased. Everything is linked by Aadhaar. So many factors are there, which when accumulated together, they will give you an indication that yes, this particular person needs to be scrutinized. So all the ratio analysis is done, all the data analytics is done, and based on that data analytics, 1% of the people are scrutinized by lucky draw. No, Abhishek, lucky draw is not there. All right, so notice is required to be given to the person who is selected for in-depth scrutiny, and notice is to be given within 6 months from the end of the financial year in which return is made. So within 6 months, the notice is required to be given. Okay. So in my case, return is filed in financial year 23-24. So within 6 months of this particular year, the notice is required to be given that yes, Mr. So-and-so, your return of income is to be selected for in-depth scrutiny, for in-depth analysis. So 6 months is the time period when the notice is required to be given. Now, up till when order is required to be passed? Up till when order is required to be passed? 9 months from the end of the relevant assessment year. So what do you mean by order? Order means after the in-depth scrutiny. After the in-depth scrutiny of your return of income, the income tax officer will pass an order stating that yes, you have disclosed your income, which is this, but you have certain undisclosed income also, which is this. So you have to pay additional tax, penalty, interest to Government of India. This is known as the assessment order. Notice is just to intimate the assessee that yes, you are selected for scrutiny assessment, and order is to finally qualify or to finally adjudicate on the incomes, receipts, and or whatever the earnings, whatever the findings the income tax officer has found out. All those are written in this order. Again, a time bound procedure. We are not giving unlimited time to the assessing officer so that it delays the process. We have given time of 9 months from the end of relevant assessment year. Now, my question to you is, what time is available to the assessing officer in my case to pass the scrutiny order? To pass the scrutiny order. After checking my books of accounts and return of income, what is the last date of passing scrutiny order? Please write in the chat box. 99% honest persons. No, Dhruv Jain, 99% are not honest people. This 1% will look richest. No. This 1% will not include richest one. This 1% will include the people whose ratios will be distorted. Last year, they were offering gross profit of 30%, and suddenly in the current year, they're offering gross profit of 8%, whose ratios will be distorted, whose data analytics will give a hint to the income tax authorities that this person is doing some jhol-jhal, some garbadi. Okay. What is the date up till which scrutiny order is to be passed? The timeline is 9 months from the end of the relevant assessment year. 9 months from the end of the relevant assessment year. Our relevant assessment year ends on 31st March 2024, and the last date is 31st December 2024. Absolutely. This time, many students are right. Harshad Soni is wrong this time also. All right. So that is the time limit. Okay. So this was the detailed scrutiny or in-depth scrutiny. Okay. Now let's come on to the next section. The next section is section 144, or the best judgment assessment. The best judgment assessment. It is in short known as BJA, best judgment assessment. Now, guys, sometimes what happens is during the course of scrutiny assessment or during the course of any other assessment, assessee does not cooperate with income tax department. Assessee does not furnish the invoices which are required by the assessing officer. Assessee doesn't furnish the details which are required to be filed by the assessing officer. Assessee doesn't furnish all those things to the Government of India, to the Income Tax Department. Assessee fails to furnish the requisite details to the Government of India, to the Income Tax Department. Assessee, with an intention to defer the assessment proceedings, doesn't file the details on time. In that particular case, the income tax authorities have the right to estimate the income of the assessee on a rough calculation basis. That is known as best judgment assessment. Please understand this word, best judgment. This is nothing but a tukka. This is a tukka. This is a fluke. This is an estimate which is done by the income tax authorities because they do not have accurate information about your income and expenses. You have not furnished the accurate information about your income and expenses to Government of India, to Income Tax Authority. They will, on their own assessment, they will, on their own best judgment, best estimate, they will calculate a rough income for you. That's it. This is known as best judgment assessment. Very, very critical section, very, very important section. Why? Because this is a penalty to the people or to the organizations who do not submit their return to Government of India or who do not submit the information to Government of India. So this happens in what case? When you don't file a return of income. When you don't file your return of income, when your self-assessment is lacking, in that particular case, yes, best judgment is worse for the assessee. Sharan is absolutely right. Sharan is absolutely right. Best judgment is worse for the assessee because in this case, income tax authorities are doing an estimate. They are not accurately calculating your tax, and obviously they will estimate on a higher side. So when you don't file a return of income, you face best judgment assessment, or you don't comply with notice under section 142.1, 142.2a, 143.2. 143.2 we have already studied over here. This is the notice which is issued for scrutiny assessment. So this notice contains the details which income tax officer wants for the in-depth scrutiny. But you fail to submit your response under section 143.2. Then you fail to submit the records which income tax want on under section 142.1. What is section 142.1? It is inquiry before assessment. Before doing any assessment, income tax officers will send you a questionnaire. Questionnaire means they will ask you certain basic questions about your business, like what is the income source that you have, how many clients do you have, what is the debtor's name which is there, what is creditor's name which you have, how many assets do you have, what inventory do you have. This is the basic questionnaire which Income Tax Act will ask you under section 142.1, which is inquiry before assessment. You do not respond to that question which income tax officer is asking you. What will income tax officer do? He will estimate your income on the best judgment basis. Next, 142.2a. This is a very, very important section. So sometimes what income tax officer feels is that through an independent chartered accountant, he would ask you to get your audit done for the entire financial statements. So sometimes the assessing officer might feel that the entire books of accounts are erroneous. They are having some problem. They are very bulky. So as assessing officer cannot scrutinize each one of them by himself. So he need help of an expert. He hires an expert who's known as a chartered accountant, and he gets special audit done by a chartered accountant. If the matter is very complex, like guys, in history, if I can remember, special audit was ordered for very few people, like Patanjali special audit was ordered 10 years back, maybe 12 years back. Then Sahara Group, which was one of the most profitable group at one point in time. For that, a special audit was ordered. Then Oracle, the software giant of the country, for those people, special audit was ordered. So special audit is not a usual audit. It is a very special audit for only for special people. And yes, income tax authorities have to justify why special audit is being ordered. They have to justify. It's not that income tax authorities will say, oh, order special audit for every assessee. Let chartered accountant see books of accounts of every assessee. No. So income tax officer cannot delegate his responsibility to a chartered accountant by ordering special audit in every case. Special audit is ordered only in cases where income tax officer feels that the books are so voluminous, they are so complex, transactions are so critical that the scrutiny is not possible without help of an expert, and therefore expert is hired. What is the name of that expert? Name of that expert is a chartered accountant. So yes, if a notice is issued to you for ordering special audit under section 142 2A, and again you fail to comply with this notice, best judgment assessment can be ordered in your particular case. So you have to make sure that you are responding to all the notices of the income tax authorities. You have to ensure that. And also you have to ensure that you are filing the return of income on time. You are filing the return of income on time. You have to ensure both these things. Only then, guys, you will be spared from best judgment assessment. And the last type of assessment is reassessment or income escaping assessment. Guys, what do you mean by re? The word re means again. The word re means again. Again means to assess again, to scrutinize again. Sir, but why would income tax authorities again scrutinize our records? Guys, income tax authorities might feel that there is some thing which is missing in your return of income, which has been missed in the initial assessment. Therefore, they want to relook at their at your books of accounts again. So, during the course of first assessment, so what do you mean by re? Re means where first assessment has already taken place and you are going to again assess the books of accounts of the assessee. This is not a unbridled power which is given to the assessing officer that yes, in every case you can file reassessment. It is only in those cases where a new information is there on record. A new information has been produced on record. Only in case of new information, reassessment proceedings happen. Only in case of new information, reassessment proceedings happen. So assessing officer cannot order reassessment in every case, okay? Only in cases where assessing officer has got some new information, in that case, reassessment can be ordered. So it's not that, sir, the income tax officer has seen our books of accounts once, they have scrutinized our books of accounts once, now he wants to see it again because he loves you, he wants to interact with you again, he loves you. Not a valid reason. There should be a valid reason to again open the assessment. And that valid reason is there has to be a new information which has come to light. New information which has come to light. Only based on new information or reassessment can be ordered. I'll give you an example. Okay. Suppose X Limited has offered 10 lakh rupees of income to tax. Scrutiny assessment happened in case of X Limited, and that 10 lakh rupees income was justified. Income tax officer had scrutinized that 10 lakh rupees of income, and it said that yes, 10 lakh rupees income is there in case of X Limited, and the taxes have been paid on time. Okay. Now, subsequently, ED is Enforcement Directorate. They raided the premises of X Limited, and huge amount of gold bars were found at the premises of X Limited pursuant to the Enforcement Directorate raid. This news was in the newspaper. Income tax officer read this news in the information in the newspaper that X Limited has gold bars in its premises. ED, Enforcement Directorate, during the raid had found gold bars in the premises of X Limited. Who read this newspaper? Who read this news? This news was read by the assessing officer who did scrutiny assessment of X Limited. So this is a new information which assessing officer can get, and immediately the assessing officer will reopen the case. Reassessment will happen immediately because now assessing officer has a new information that there is an income which has escaped assessment, there is an income which has escaped scrutiny. This is the example of the case where reassessment happens. So reassessment cannot happen on a tukka basis. Okay, I want to do reassessment of this particular assessee. I will do reassessment. No, it cannot happen on a tukka basis. Once more to assessee. Yes, Sharan is absolutely right. Reassessment is when IT department says once more to the assessee, but that once more should be based out of some new information. If new information is not there, reassessment cannot happen. Now, guys, you can appreciate, and yes, we'll discuss the reassessment in next slide. You can appreciate the fact that what is the fact I'm trying you to appreciate, guys. You can appreciate the fact that all these assessment proceedings have a different purpose because of which they are there in law. All of these assessment proceedings have a different purpose because of which they are there in law. So all of this serves a different purpose, and therefore these assessment proceedings are there. Now coming on to the much coveted and the much litigated proceedings, which is known as reassessment proceedings, and the section has been changed in the Finance Act 2020. And for your examination for June 22 and December 22, definitely this amended section is applicable. I most like ED. Okay. So for CMA Intermediate student, this procedure is not there in their syllabus. Neither the notices and the orders are there in their syllabus. This entire section is not there in syllabus of CMA Intermediate student. This is there only in case of CMA Final students. But still, guys, it is so exciting. I know you are still live on the chat box, and I can see your excitement. You are so excited that I'm very sure that even the CMA Intermediate student don't want to go out of the live. They don't want to leave the live, and they want to study what is income escaping assessment and how does it happen. I'm very sure even when this is not relevant to CMA Intermediate students, this is only relevant to CMA Final students. Even in that case, CMA Inter students are very, very excited to study this particular section. I can feel the excitement in the group. Yes, sir, we are very, very excited. So what if it is not there in our syllabus? We will surely study the reassessment procedure. Yes, sir, amazing session. Absolutely, Om Kakati. Yes, so reassessment proceeding, one of the most critical, one of the most litigated sections which is there in the history of litigation. And guys, I have personally handled a lot of cases of reassessment proceedings. I have personally done a lot of reassessment proceedings along with the income tax department, and I have handled a lot of cases for reassessment proceedings with the income tax department, because the one thing which we challenge in reassessment proceeding is that does AO has any new information because of which he's opening the case, or he's reopening the case based on his dreams or on his whims and fancies. So guys, listen to me. AO cannot say that in my dream, I saw that go down of X Limited was filled with gold bars. AO cannot say that. AO cannot say that. AO cannot say that in my dreams I saw that X Limited go down was filled with gold and silver bars. In my dreams, therefore I want to reopen the assessment proceedings of X Limited. AO cannot say that. But yes, AO can say that Enforcement Directorate had raided the premises of X Limited and their gold bars were seized, and therefore I want to again open the assessment proceedings. Yes, the assessing officer can say that. So assessing officer, having said that, about reassessment proceeding or income escaping assessment, when assessing officer says this particular thing, your income escaping assessment starts. Let's start the section. So section is divided into two parts. Number one, to prove that AO's claim that he has certain new information is correct or incorrect. So if AO is saying that oh, I have got a dream that the godown of X Limited is filled with gold. I've got a dream. If AO says that, do you think it's a valid thing to open a reassessment proceeding? Please answer in the chat box. Do you think it is valid that, oh, in the dream I have seen that X Limited godown is filled with gold bars and silver bars? Is it a valid point of income tax department? Is it a valid point of income tax officer? Please answer in the chat box. No, answer is no. It is not a valid point. No, absolutely. It's not a valid point. So, first of all, the first step in reassessment proceedings is that you have to inquire on the reason for reassessment. Why are you opening the reassessment? Tell us the reason, income tax officer. So, the first step is to check whether reason is correct or not. That is inquiry. And if the reason is correct, then assessment is going to happen. So, section is divided into two parts. First, check the reason. What is the reason for reopening the case? What is the reason for saying once more, once more, once more? What is the reason for saying that once more the assessment proceedings are going to take place? And then if the reason is correct, then do the assessment proceedings. Now let us see. Scrutiny assessment under section 143(3) may or may not be concluded. Now, the original assessment might not be concluded. Even then, reassessment can be opened if the timeline has been lapsed. Okay, time has been lapsed for the original proceedings, the scrutiny assessment under section 143(3). If the timeline has lapsed, even then reassessment proceedings can be opened. So, scrutiny assessment under 143(3) may or may not be concluded. New information indicates income chargeable to tax has escaped assessment. So there is a new information with the assessing officer which suggests that there is some income which has escaped assessment. Issue show cause notice under section 148A to conduct inquiry on new information. Now, first of all, the assessing officer should intimate to the assessee that, look, X Limited, Enforcement Directorate have raided your premises and they have found gold bricks in your premises. I want to open your reassessment. Please tell whether I should open the reassessment or not. So maybe X Limited will say, sir, that was a printing mistake in the newspaper. It was not X Limited. It was Y Limited of whose information was submitted. I am X Limited. Raid has not happened in my premises. Raid has happened in Y Limited premises. Newspaper, the Times of India, have miscalculated or have misspelled the name from X Limited, from Y Limited to X Limited. Once assessing officer issues a show cause notice to the assessee might respond to the assessing officer saying that, sir, the reason which you have is definitely not valid. So, issue show cause notice under section 140A to conduct inquiry on new information. Whether new information is correct, whether new information is incorrect, you need to assess. Yes, Ishita. Yes, Ishita. In all the ED raid cases, income tax authorities go for reassessment. Yes, absolutely. Pass an order under section 148A deciding whether it is a fit case for 148 or not. The assessing officer has to finally pass an order that yes, the reason which was there with me was wrong or was right. Okay, either the reason was wrong, that the raid happened in premises of Y Limited, misspelled as X Limited in the newspaper. Either the order is saying that the information with the assessing officer is wrong, so the reassessment doesn't happen, or the assessing officer says no, my information is absolutely correct and I want to reassess the case of Mr. X Limited. Once the assessing officer passes the order that this is the fit case for reassessment, then guys, assessment happens. Assessment happens over here, that it is a fit case for assessment. So assessment happens over here. Issue notice under section 148 along with 148A requiring the assessee to file the ROI. Then the usual assessment procedure happens. Reassessment procedure happens. Assessee is required to file the return of income. Assessee, if assessee wants to suo motu on his own will disclose higher income, he can disclose higher income. He's asked to file return of income. Then an order is passed under section 147 after conducting the reassessment proceedings. New issues may be considered during reassessment. Reassessment may not be done when assessment is pending. Now, I'll take these two steps in a short while. First, I want to discuss the timelines. Now, the timelines are that the notice is to be issued under section 148 along with section 148A requiring the assessee to file a return of income. So, the notice of assessment, reassessment is issued by the assessing officer for the assessee. The notice is issued. Now, the timeline which is given for reassessment is 10 years. If the income which is escaping assessment is more than 50 lakh rupees. And if the income which is escaping is less than 150 lakh rupees, then 3 years from the end of the relevant assessment year. So guys, extended timeline as compared to the normal scrutiny assessment. This is the extended timeline. Okay, so 10 years from the end of relevant assessment year, if income is 50 lakh, income which is escaped is 50 lakh. So if it's huge income which has escaped, 10 years are given to the income tax authorities to reopen the case. And if the case is a small case where only 50 lakh rupees or less income is there, escaped assessment, then within 3 years, from the end of the relevant assessment year, the notice is to be issued. These are the timelines. Now, these are two important issues, guys. These are two important issues. New issues may be considered during reassessment, and reassessment may not be done when assessment is pending. First of all, we are concerned with the new issues. Okay. Now, let me reiterate my example. X Limited ED raid happened, and X Limited said that 50 gold bars have been found at the premises of X Limited. Making this as the base, income tax officer issued a notice on X Limited saying that 50 gold bars have been found at your place. Therefore, I want to open the reassessment. Now, the information was 50 gold bars. During the course of assessment, during the course of reassessment, it was found that it was not only 50 gold bars. Along with 50 gold bars, there were 100 silver bars also. Now, the question is whether the reassessment should be done only for the 50 gold bars, which was the information which was produced while the reassessment was opened, or the assessment should be done for 50 gold bars plus the 100 silver bars. Answer is the 100 silver bars should also be included in the reassessment proceedings. So any new issue, if it comes before the assessing officer during the course of reassessment, that new issue should also be taken up in the reassessment proceeding. New issue means some new matter, some new thing has come up to light. So any new issue which has come up to light, that should also be considered during the reassessment proceedings. Next, reassessment cannot be done when original assessment is pending. Guys, this is very, very natural. Okay, what is it? So suppose if your scrutiny assessment is going on, then can you open reassessment? Answer is no. If your normal scrutiny assessment is going on, then whatever new information you have obtained, you can adjudicate that during the original assessment only. Why do you have to open reassessment? Reassessment is opened only when original assessment has been closed or original assessment was not done and the time limit for opening original assessment has been lapsed. Only then reassessment should be opened, right? So reassessment can be opened only when the original assessment have been closed or the original assessment have been, the time for doing original assessment has lapsed. So please read the second point. Second point says reassessment may not be done when assessment is pending. When the original assessment is pending, when the original assessment is already taken place, you cannot open reassessment. What is the use of opening reassessment? You do the scrutiny in the original assessment only. What is the use of doing reassessment if original assessment is pending? So that is the point which is given over here. So two important points which are given over here. So guys, this was the section on reassessment proceedings. This was the section on reassessment proceedings. Okay, sir.